All right, I'm home. Can someone DM me the link for the JPOW meeting? All right. A little earlier. Turn that off. The video's fallen off a cliff. That's what I like to see. Yeah, Squamsk. No, I just had an allergy test, so everything is the worst. Taurus keeps increasing. It shot up the past 2 days. It appears once it crosses 370, which it did yesterday, there are some downs within the next 5 to 30 days. Are you using TDEX? I'm guessing you were positive for allergies. Yeah, no shit, Sherlock. Um, Lily almost hit 450. Nice. I made one DTE 427 spy call is up 50%. Am I winning yet? It's pretty good. Discord audio muted. Sorry. That should be better. You know how the whole market says AI like 85 times in their earnings call to make their stock go up? What if JPOW says Volcker 85 times in his speech? I wonder if it's the reverse Uno card. Maybe. I can't find this fucking speech anywhere. Oh, here it is.
Trends, as Stephanie touched upon, or we could think of changes in idiosyncratic and aggregate earnings risk, or the ability of households to insure against that, how sophisticated financial markets are. All of this is going to map into what equilibrium real rates look like. Okay, so these could be more primitive, more causally interpretable structural shocks, what I call
Is this it?
that would be moving around the long run real rate R star. And so by extension, then also would be moving the various other outcomes we're interested in, output, inflation, and so on. Okay, so then kind of with this bit of abstraction in the background, what is it that kind of in my interpretation this paper is doing? So what you kind of saw with kind of when Stephanie presented the main model setup that they're estimating, what this at the end of the day gets towards is it gives an estimated series of the real rate. So here R star in their notation XTR. And then essentially what the estimated model is doing is projecting on innovations in that smooth.
Oh, it's at 11?
Okay, so in particular what I'm saying here is, so you have your outcome of interest Y, and these can be impulse responses,
I kind of want to watch this more. This is dope.
in the estimated real rate. Okay? So I'm indicating that as innovation at the AT controlling for everything else in the past, and that's the dynamic causal effect you're trying to tease out. This is the econometric estimate of what this paper is doing, or trying to recover. So then if you combine that with what I had before, and it's just a couple of lines of algebra to see what is it that this paper is kind of giving us through the lens of the setup I've written down here. It's in general going to be some linear combination of the various primitive shocks that are actually driving the natural real rate R star. Okay? Now the question is, okay, so we have this innovation. We know it comes from a bunch of potentially heterogeneous underlying primitively interpretable structural things. So what is it that we're estimating? Well, we're estimating a weighted average of various underlying potentially heterogeneous treatment effects, okay? And I do think that heterogeneity is potentially important. Like if I think of these structural determinants, I think
is brandishing a camel tux in public more common with this generation
versus say changes in credit spreads and so financial sophistication.
Yeah.
Could
no, it's
probably in general do have different dynamic causal
brandishing
effects on
anything
household
is
labor
more common
supply,
with this
on
generation.
consumer spending over the life cycle, and so in particular on output and inflation. So one part that I kind of would like to see made at the beginning, and it's part of that is actually already in the paper, and I'm going to say soon where it is like what I would like to see is an argument along one of the following two lines. One, and I think this is where the paper is kind of going with the demographic discussion that Stefan had at the end, that maybe R star is indeed driven by a single and structurally interpretable kind of innovations. That they're these super cycles that don't align with what demographic transitions look like. So maybe the shock, even though in principle demographic transitions are driving some of the variation in R star, this is not the main shock whose causal effects we're picking up. Okay, so this is one argument. The other argument you could be making is that the various main shocks that drive R star actually do end up having homogeneous effects on everything you're interested in, then I don't care that I'm computing
Mute that guy and talk about
I don't think that's a particularly promising argument. I think the first one is the more promising one. But I will also get back to...
All right, fine. I want to go back and watch that, though. This is cool. Hold on. Where's my... Oh, there it is. All right, let's see. Some call interest at 41.25, 42.25, 42.20. Some call interest at 4,200, which will probably act as resistance. Put interest 41.70, 41.75. I would say the gamma structure is very similar to what we saw yesterday, with, you know, a large amount of call volume protecting any relevant downside, and lower than normal put interest near the money. However, VIX is going up, so it may be that we're seeing more puts come in. That's interesting. You know, if you look out here on ES, we appear to be very near the top of this, well, this range. Oh, sorry. I don't know what this is. It's not clear without the handle. The bear is part of the TA. Gherk, thoughts on this, please? 0 DTE, 41.25, 41.30. Bear call spreads, max profit 500, max loss 0. This is a 0 downside position. Am I missing something? I mean, the max loss shouldn't be 0. The max loss should still be the spread, were we to fall into the... Huh. Why would that be? Yeah, that you would still have a $500 loss for the spread. I think it's just if you're doing it on fucking option strat, it's just that you can't lose more than the spread, but you can still lose 100%. You will if you open it right now and the price doesn't fall back below 41.25. You'll just lose $500. Because at the end of the day, like, say we go nowhere near those strikes, at the end of the day, those are going to cash settle, and there's still a $5 difference between the strikes. This is uncanny. 41.13 to 42.02, or 212 BPS in the 2 days before JPAS speech this week. August 26th, Jackson Hole, 41.20 to 42.03, or 201 BPS the 2 days before. Yep. I'm starting looking out today. Oh, let me just take a look at it. Yeah, it's not looking so hot. We're actually starting to see liquidity begin to collapse here. That's probably not a good sign. Interesting. All right. Brock Tanner, welcome to Cornichon, man. Thank you so much. Max loss is 60 on it. Well, maybe the values of the options change when making it. Maybe. I don't have the calculator up, so I don't know. But it doesn't I'd have to look at it. NASDAQ red on the day? What is this? Some kind of unbullish thing? Man, my ape brain is telling me to buy puts right now. You play on Jimmy upside of this OPEX? What gives? I don't know. Have they done the Russell announcement yet? I don't know if they'll announce that till the end of the day. Ice cream sandwich. Thank you so much for hooking up Sturkey. Sturkey, welcome to Cornishon. Give Danwich a shout out, man.
Cornishon. Cornishon.
I just want violent dump side potential. I see. I thought you were full bull, Bob. What happened? Did the bulls get too ridiculous for you? I think the calls are getting priced up a bit. I bought one DTE 4240 for Monday, 936, and it's still up. Maybe. Ran out of tea. I see. If they make the announcement today, will the ETFs be selling and buying at the end of the day? Most of them won't. Index ones won't, but others that aren't weighted to the Russell 1000 may, like value ETFs, like retail and value ETFs may change their holdings. Mutual funds may change their holdings, but the reconstitution officially occurs in June. So that's when like things like IWM and IJR and stuff like that, that's when they'd rebalance. Actively managed funds that rebalance on a faster schedule, those could rebalance before then. That's what I'm concerned about. Is we had a big ETF dump of liquidity back in December on GME, and we got fucking the shit shorted out of us right before like OPEX, right? So I'm concerned that in addition to Russell 2000 will free up liquidity and create an OPEX. So I want to see how liquidity reacts over today and into Monday morning before I take any like long positions. And if that means missing out on scalping, what is probably only potentially like a $4 run on GameStop, I really don't care. Danwich, thank you so much, man. Guys, give him a shout out and welcome to Cornishon.
Cornishon. Cornishon.
A video with the bear flag that'll break up? Maybe. I would be very happy if NVIDIA closes today below 310. Because I already sold my calls. Like my call had just gone. What's up, Gherkin Barry here? What price does SPX need to break down to in order to confirm downside? 4150 at this point. 4150 I think is where the current batch of sold calls or sold puts are positioned. So breaking through those would be very important. It's also where gamma neutral is. Or well, where gamma neutral was yesterday. I guess gamma neutral probably moved a little bit today. And gamma neutral's at 4153 currently. And this week has been wild. Yeah. It's been fucking crazy. Is his speech not going to be available online? It's only going to be available on C-SPAN? Or is it already available? Hmm.
A healthy democracy doesn't just look.
Live. I must correspond to association dinner.
A healthy democracy doesn't just look.
No.
A healthy democracy.
Shut the fuck up. What does a healthy democracy look like? What the fuck? Powell's speech should be on YouTube. There's a link on the Fed's webpage for the conference they're having all day. Okay, so is that so the research conference that I was watching earlier, that's the same one? And then Powell's just on at 11? Oh, okay. Okay. I know where that is then. So I'll just keep that. What are the odds JPOW doesn't say anything that'll affect the markets? I mean, I guess there's a chance he doesn't. Although it is a conference on monetary policy. To quote Girk from February, I wanted to taste the sweet, sweet nectar of 4,200. Well, here it is. 5 months later than it should have been. 3. Whatever. Kind of wanted to taste it in Jan, too. Seems like there's going to chop around the range until JPOW, first of his name, ruler of men, king of the markets, and protector of the realm, speaks. Then it will become extremely volatile. It's possible, yeah. If there's any negative sentiment from Powell, will it be felt today or will it bleed over to Monday? I don't know. I mean, it'll probably have some impact immediately. Everyone works for Citadel. I managed to make $10,000 in commissions this week, all while listening to the entire stream. You are hereby witnessed by the Let's Cock. Thank you so much, Danwich. That's awesome, dude. Congratulations. Calls are so fucking expensive. Playing the upside sucks. I know. Oh, hold on. I have Ko-Fi off because of walking. I had my land, air, and sea sandwich this morning. It was bacon, egg, and cheese. The land was the bacon and cheese. The air was the chickens because they're a bird. And I put sea salt on the egg. Chef's kiss. Upstart, $26, 0 DTE. Same like SPX hedge? No, probably not. Selling calls right now and cutting before 11 seems to be a good idea. You're not going to make a lot of money on 30 minutes of theta. Are the bulls running out of steam yet? Are they? No. I mean, they've got calls at 4,200, like a fuck ton of them. And calls at 42.20 and 25. Also a fuck ton of them. So I don't think they're running out of steam just yet. Well, I do feel like a strangle is appropriate here. That's the AM expiration. No wonder the spread's awful. Jesus Christ, calls are so expensive. I'm $15 out of the money and like fucking contract is $4. Yeah, they're not cheap. Are you the one who said in a bull market you just buy expensive calls and wait? Yep, pretty much. Oh, you can also like buy things and then sell covered calls on them and forget about them. That's another really fun bull market strategy. Are they trying to price people out of a squeeze? No, I mean skew's just favoring the call side right now. A week old room temperature milk did not keep well. Hmm. More of a yogurt or cheese now, isn't it? Is this the soft landing? Super hard pumps into giant fall offs? Yeah, seems that way. One would have thought a soft landing would have been more like, just that and not that. But, you take what you get. It's like a soft landing under the side of a mountain. No, there's no daily DD. I didn't get home from my allergist appointment until like 10 o'clock. Did you see Fubo's price action for OPEC settlement next week to be pretty tame? Looks like a lot of the liquidity has been realized to keep Fubo down. Yeah, I don't think there's going to be much of anything for OPEX for Fubo. The only one that looks really good right now is GME. Maybe Tesla a little bit, but Tesla's already blown off some steam. Um, and GME, I still wonder what's going to happen with this R2K shit today. The more calls skew up, the more likely someone will buy puts to equalize. Yeah, I mean, puts become cheaper and cheaper, right? So that incentivizes the purchasing of them. I've been waiting for JPAD to say what he's literally been saying for months. Yeah, but the market reacts to him saying the same thing over and over again, the same way every time. What if, and this might be big, if Jackson from the Discord and his SPX 12,000 Cs is really Tom Lee's burner account? I wouldn't be surprised. We already know Kramer's invaded the pickle jar, so what previous time frame do you think this current market is most similar to, in your opinion? Thanks, Girk. I still think there's a lot of similarities with like the .com bubble, where earnings kept getting led higher by guidance while margins were collapsing, and then ultimately that ended with bigger tech companies diluting in order to capture their insane overvaluations, right? And that eventually triggered the collapse of the .com bubble. There are some similarities to like late 07, early 08. I mean with the bank failure obviously, but also with the slow bleed of MBS and CMBS liquidity. I mean, obviously, nothing's the same as it was back then. A lot of things are different. The effects of like volatility trading on the market are very very different than they were back then. So there are other factors that make this time around different, but I don't think the economic environment is any more favorable than it was back then. I don't think we've ever started descending on the landing. We started lower altitude, then pulled back up because other planes were on the runway, waiting for air traffic to give us clearance. So we pump when he says no rate cuts. You got it. No, it's not. It's not all the crashes we've had combined. Hope your allergy test went well. I've seen this stock streamer went on antihistamine and doesn't remember his awesome trades. Well, they print. Will the good doctor give you some nice meds? Well, they want to give me allergy shots, but they want me to come in every day for the like every week for them at like 2:30 on Wednesday. And I'm like, I can't do that. So I need to find an allergist that's open late, which is not easy to do. It also takes like 6 months to get an appointment sometimes. If I don't want to get assigned to my 519 $20 GME CCs, do I buy them back at a loss and resell a CC for further out to get some credit back? The best way to get out without assignment. I mean, you can do that to dodge assignment. Yeah. That's an option. You could do first in, first out if you want to keep your tax, like your tax status. I think you can I'd have to ask Bipolar Bear, but I'm pretty sure that you can buy a call at the same strike and then exercise it and then use the new exercise shares to satisfy the covered call. Last in, first out. LIFO. Last in, first out. You can sell a CSP at the same strike. You can roll it. Also seems like the market is straddling JPOW at 42.10. It would appear that way. I don't know how much straddling's going on, but would you say Fubo, GME, Upstart have realized some liquidity this week? I wouldn't say GME's realized a lot. I mean, it did through ETF FTDs, but not a ton. It's pretty much as illiquid as it was when it started this period. Did you tell your allergist that you could not do 2:30 p.m. because you're a stock god? Yes, Grim too. There are allergy vaccines in tablets or drops that you take at home. Interesting. Double bottom on QQQ. Cool. If you do LIFO, you can't just flip-flop to FIFO LIFO when you want. It's gap. But you can turn it on if you haven't turned it on yet. Zero GT 4250C, volume at 16,740, and nearly you can actually choose tax lots when you get assigned. So you kinda can do it whenever you want. Zero GT 4250C volume 16,740, and nearly 1/3 of that volume was from 2 trades. Someone bought 5K contracts at 950, or they sold them. Well, if you do that, then you only lose the spread. So like however much the stock is up above the strike you sold at, but you keep your tax preference on your longer dated shares. What's up, Referral? We're just hanging out, man. I'd be careful with just treating your symptoms of an allergy. It can get worse. Yeah, I know. I've had cats before though, and it's never like usually I've gotten acclimated to them. Like it hasn't gotten worse for me. Like I know that that happens for some people's allergies, but I had cats most of my life. Slide down to 42.20 on ES until 11. Spike above 42.30. Then plummet the rest of the day. Let's go. That'd be cool. I'd take that. JPOD gonna come in and say bull market and make us rocket into the biggest bull trap ever. Yeah, exercise on my $14 519 upstart CCs. What do I do with my hands now? Find something else. Pump to 4250, dump to 4100 by end of day. That would be ideal. How about just dump to 4100 now? Have you tried eating a tablespoon of local cat every morning to help with your allergies? I haven't. That's a great idea, though. Thank you. If ES goes above 4230, it will push for 4250. Probably. Although I do think, aside from any crazy spikes here, that ES is probably around the top of its range. There aren't a ton of buyers higher. If not the top of its range, very close to it. Don't forget there's much bigger SPX positions sold to the upside than the hedged equity fund 3 from yesterday. Well, we have like the big JPM collar at what, 42.35, is it? Gamma max for Nvidia. Hold on. $308.61. Oh, there's no more resistance to the downside at 40.50 Celtic. They pulled that shit back yesterday. Like the sold puts that were down there, they closed most of those. Most of their sold puts now are at like 41.50. So they sold all their puts at gamma neutral. Pardon my ignorance, but of these large red candles on the 5-minute for SPX, this sells to their liquidity deposits, and they just keep pumping it back up after rinse and repeat. That's very possible. And yeah, I do think some of the sell-offs yesterday, at least on the future side, were possibly SLD sell-offs. But they haven't been very big. Generally speaking, the SLD sell-offs are much, much larger than that. Those have been small. How are you playing this speech? I mean, I'm holding on to my straddle from yesterday. So I'm still just straddled at 4,200. I actually really don't care about capturing upside profits, so I'm gonna hold on to the calls for a while, at least until there's either a breakout, like a big breakout to the upside, or Powell's speech is over. Can we at least fill the gap? Yeah, we could. Since Nvidia still over Gamma Max and how far it's run the past 2 days, if the market turns down, how low can Nvidia fall today? It could go back under 300, I think. There's a lot of sold calls. Like for 616, even in the money. So I don't think it'd be hard to slip 300. Lowly thesis defeated. I mean, it still has another month. You can close it if you want. I don't really have any reason to. I mean, my max risk there is like 12 grand. But I actually don't care that much. I think the risk reward at this point is just, I might as well hold it. Can you run through the Russell switch and the potential impacts? I've only caught bits and pieces. If GME's added to the Russell TK, Russell 1000 ETFs will sell it. Russell 2000 ETFs will buy it. GME's liquidity will be a lot higher, but because its ETF holdings will increase, but it will have more active fund volume. So that'll be cool. That at least in 2021, that helped drive obligations. It could also help drive options buying. So short term before it's kind of bearish. It could unlock a lot of like liquidity and clear up a lot of currently outstanding obligations on GME. But long term, it's probably bullish. Yeah, short stops are above 42.26. Pushing and holding above that will make them all close, and it will rip to 42.50. Okay. You know they can just move, right? I just realized a fundamental truth. Mount Rushmore needs more JPOW. The stream card must become real. Make it happen. There's a whole lot of dollars between those two, like 25. Yeah. If we fill the gap, do you see the market to continue downward, or is it more dependent on Powell's speech? It's more dependent on Powell's speech, I think, at this point. Do we know what Jimmy's price would need to be per share to keep it out of the Russell? It's based on market cap, so I'm not sure the price per share, but Jimmy's market cap is like $6 billion, which is well below the upper limit for the Russell 2000. Now, when it was added to the Russell 1K, its market cap was significantly higher. I mean, triple what it is now. Oh, hold on. All right. Yeah, I mean, the last time when Jimmy got moved, you know, it was trading at like $40. I think it might have been higher. It might have been like 47, around there, when it was added to the Russell 1000. If it's not included to the R2K, no liquidity to be had, and we're left with a potentially large OPEX. Maybe. I mean, the borrow rate's still not up. So there's still no active shorting. Can you go over the significance of SPX nearing 52-week highs in a bear market? I realize the macro environment doesn't imply one, but since Jan, it's felt more and more like we're in one now. I mean, it doesn't really to me. I don't think we've moved to levels that I would call the levels of a bull market. I mean, we're still under August high. You think we get a dead cat bounce in FL today? When something gets sold off after earnings, are there indicators you can use to determine if there will be a bounce? You can look for volume declining in the sell-off period. That's usually pretty helpful. Look for stabilization, obviously. And then, yeah, I mean, you can enter a position and you kind of just hope it bounces. Powell gonna make us some money today? About to find out. Hello, Greek. It's your allergist. I hate to tell you this, but you have allergies. I'm sorry. Shit. I mean, you can look up the Russell like the Russell decision date from 2021 and look up GME's price from that day. You don't need my help. Looking at the calls going out to 616, everything looks bullish and call heavy. How much should the prudent investor heed the options chain versus fundamentals and negative macro situation? Really? Because I don't see a lot of bot calls out to 616. There's very few of the calls on the chain are for 616. Six sixteen is currently 1.6 million calls, 2.7 million puts, with a 1.66 ratio. Yesterday, JFresh was saying bullish things in the Discord. Is he being facetious, or has he begun a descent into madness that only a market crash can cure? Possibly. He was also pretty drunk, and blowing up his port on spreads that are too wide. So I think he might be better today, but I don't know. I taught I think I showed him how to fix a spread that's previously fucked you. And I don't think he's at risk now, so he's hanging in there. Any indication JPM rolling their collar yesterday? Any indication of JPM rolling their collar yesterday? I think so. But I couldn't confirm it. There was a shift in the skew at like 4190 that made me kind of wonder if the collar had been rolled. But that also might just be like the expiry of the smile I'm looking at. I think some other sold calls at 4190 definitely got closed. JFresh hasn't been the same since ChatGPT took his job. He'll bounce back. I hope JPOW comes out and says he's disappointed in the market participants for running wild. It's time for Dowdy to calm this place down. He needs to do a lot more than that. Counterpoint, if SPX 0 DT plus futures keeps making money, won't they keep doing it every day? Well, they don't do it every day for a reason. It's not sustainable. It builds tail risk. They can generally only do it for like a couple of days. It also eats up shitloads of liquidity. My gut tells me that if Powell's stance hasn't changed, there's absolutely nothing he can say that will pump SPX, but the options chain would like to say otherwise. True. Although the options chain can change very, very quickly. This is one of the problems with everyone relying so much on gamma data. That can change in 5 seconds. The entire chain can shift bearish in less than 5 minutes. And the at the money shit can change in a couple ticks. I mean, we've seen it happen before. We've seen them just snap pullback call positioning and the market just drops, right? We've seen it plenty of times. In Discord last night, you observe that this run on SPX was a risk off. I think it is. What would you need to see to confirm that? A big fat fucking dump. Yep. What would you need to see to close long dated puts? Long dated calls? No, like actual flow of liquidity into equity markets, which I'm not seeing. I mean, all of these moves to the upside continue to be derivative driven, with no real capital flow into the equity market. So until there's a change in that, right, and money stops flowing out of equities, which is what it's currently doing, and starts flowing into them, I'm not going to be bullish. One Strangle with 2-to-1 levers to the downside. Let's go, Powell. Let's go. Same. I'm strangled and straddled, dork. It's the most sexual position I've ever had with SPX. I really don't know if it matters what JPass says today. I think they can sell off regardless. Yeah, they can. They could just sell off regardless of what he says, right? If JPass refers to himself as daddy even one time, I'm full porting 3000p. Rolling the dice on GME, $22 GME cover calls expiring today. I don't care if I get called, but you think I've got a shot. We found resistance both times here. I mean, let me look at the options chain. I don't think 2180 is out of the question, but I need to see what the sold calls look like right now. Give me a second. Oh. $22 is tricky. It could fall to 20, like 2150. Let me see what today's expiration looks like. But there's a lot of 0 DTE calls at 23. So there's a chance that we could keep just bouncing in this range. Like we could say trapped at like between 22 and 23. I mean, if the market sells off, then yeah, you'll get lucky. But otherwise, there's a chance it doesn't. You could try to wait for the Powell speech, see if the reaction's overly bearish. You might lose a few cents on the spread, but at least you'd have a better idea of the certainty. Nvidia back below 310. Getting close to, what's Gamma Max? 308. Something like that. I think it's actually just 308. What's up, Colorado Kev? Welcome back, man. Yeah, absolutely, dude. Oh, money? No. Barely staying break even through most of this week. It's this week's been rough. Straddles are still dope, so you haven't missed out on that. Thanks for your explanation on why 0 DTE pumps can't last. I have July and worried about rolling. I mean, July, you don't really need to worry about rolling just yet on July, unless it's moved to a level that it's absolutely unsustainable for your position. But otherwise, I mean, you've got what, 40, 50 DTE on July's? 63? 60 to 45. Some theta decay will pick up, but oh shit, Powell's speech.
Shaped your views, particularly about your thinking about monetary policy. Paul Volcker, in his oral history interview, tells the story of his mother, who was adamant that he received the same dollar value monthly allowance.
What the fuck? Okay, I don't want that.
Do you have any such stories to tell?
Maybe not quite that on point, but so I graduated from college in 1975 during what we now call the Great Inflation, and same college year as Ben. And I started working as a lawyer in the financial sector in the late 1970s. I recall from that time a growing sense that high inflation was essentially a permanent part of the landscape, just something that we all had to accept and deal with, and that the costs of getting rid of it were too high. So you just were getting used to it. Of course, ultimately, the Fed did step up and restore price stability. And one lesson from that era is that price stability is really the foundation of a strong economy, and that the economy doesn't work for anyone without price stability. Another is that high inflation when we have high inflation, it is the responsibility and the obligation of the central bank to restore and sustain price stability. So today, while inflation isn't as high as it was when I was in college, it's nonetheless far above our 2% objective, and many people are currently experiencing high inflation for the first time in their lives. It's not a headline to say that they really don't like it. So we are very aware that high inflation imposes significant hardship as it reduces purchasing power, especially for those who are at the margins of the economy and living paycheck to paycheck and need to use all of their incoming income to pay for food, housing, and transportation and other essentials. And that's why the committee is so strongly committed to returning to our 2% goal. We think that failure to get inflation down would not only prolong the pain, but also increase, ultimately, the social costs of getting back to price stability, causing even greater harm to families and businesses. And we aim to avoid that by remaining steadfast in pursuit of our goals.
Thank you. Ben.
Well, I had mentors, Dale Jorgensen at Harvard and Stanley Fischer at MIT in particular, but I'm going to tell you about something that happened to me when I was 6 years old. I used to visit my grandparents in Charlotte, North Carolina during the summer, and I would sit on the front porch of their house and listen to my grandmother tell stories about her life. And she told about how she raised her family in Connecticut in the 1930s during the Great Depression. And it was a town that was specializing in shoe manufacture, and during the Depression, a lot of the factories were shut down. And she told me that, it was a very hard time. A lot of the kids went to school in tattered shoes or maybe no shoes at all. And I said, Grandma, why would they do that? And she said, well, because their fathers lost their jobs. Why did they lose their jobs? Because the shoe factory shut down. Now, I was only 6 years old, but I could see the problem with that argument. I said, well, why didn't they just open the shoe factories and make shoes for the children? And she said, it doesn't work that way. But I think it really was a puzzle to me that you had the same productive capacity in 1933 that you had in 1928. And in 1928, people were dancing to Charleston, and in 1933, they were in bread lines. And that really impressed on me, that economics can make really big difference in people's lives. And monetary policy is like that. I mean, it's, as Jay, of course, and all of you well know, that the decisions made in this building have a very broad and real effect on people's lives. And for that reason, besides its intellectual fascination, it's worth studying and understanding.
Yeah. Thank you. I know that's certainly a key motivation for many people in this room to be working so hard. Okay, let's now turn to some topics of more current interest. And I'd like to start with the nexus between the financial system and the macroeconomy. Both of you, during your tenures as chair, have faced very significant historic financial crises. Ben, obviously you confronted the global financial crisis, and Jay, the global pandemic. Those episodes were clearly acute, very vivid examples of the connections between the macroeconomy and the financial system, as well as, I think, a good illustration of the role of central banks in such episodes. But Ben, your research, importantly, and the research that you have inspired, has really demonstrated that understanding the connections between the financial sector, credit markets, and banks and the real economy is critical for even understanding traditional business cycles. So with that as background, we have just experienced a period of stress in certain parts of the banking system here in the United States. So I want to get your take on those developments, how you think they match up compared to some previous episodes, and what they might mean for the economy.
Well, in some dimension, the recent crisis has followed the standard sequence. I don't know anything about Silicon Valley Bank other than what I read in the paper, so please don't misinterpret this. But it was a classic situation where they had assets that were subject to risk. In particular, as interest rates rose, the value of their long-term assets fell and their capital fell. They had hoped to hedge that by their deposit franchise, where as interest rates rose and interest rates moved more slowly on deposits, that would partially compensate, but they were dealing with customers who were very social media savvy, and that didn't really work. So after the decline in capital, you had the second stage, which is runs, people taking out their money, which ultimately led to the collapse of the bank, despite, I may add, the good efforts of the Fed and the FDIC to provide liquidity and provide support for depositors.
Bullshit.
The third stage of a banking
well, for
crisis is
depositors, but not for the
contagion.
bank.
People looked at other banks and said, oh, they look sort of vaguely like Silicon Valley Bank. They got the same number of letters in their name and all kinds of things like that. And that caused people to begin to remove deposits elsewhere. And finally, the reason this is important is that it ultimately affects credit conditions. And the Federal Reserve is, of course, looking at the effects of bank problems and other financial issues on the extension of credit and therefore on the real economy. So, you know, in that respect, I think it's very similar to other crises. I think it's different from the global financial crisis in many ways.
The purple
including
tie
the
is always
scale and
downs,
scope, of
isn't it,
course,
Dork?
but,
I don't
I
remember
would mention,
the chart.
A couple of
but-
things, a couple of important differences. One is that the impaired asset in this case was U.S. Treasuries, which are very different assets in kind from subprime mortgages, in that U.S. Treasuries can always be valued accurately, and so there's not the uncertainty that was associated with subprime mortgages. And secondly, as the economy
What about the
declines,
uncertainty with prime
or if it does
mortgages?
decline, U.S. Treasuries actually become more valuable rather than less valuable. And
Is
so
he going to
there's-
mention?
there's kind
Is
of
he
a
going to mention
countercyclical
prime mortgages?
effect. So that's one very important difference, I think. And then the other worth mentioning, but very important,
Bernanke's
is that
gonna crash the
relative
market
to,
a
say,
second
the
time.
GFC or the Great Depression, overall borrowers are
Yeah,
in much
talk about
better
the
shape,
Depression more.
you know, than they were
Please.
in these previous episodes. And that makes a big difference, both in terms of the stability of the banks and also in terms of the impact on consumer spending and the economy in general.
Well, I guess a major reason that situation didn't get worse, and I think the contagion was very much contained, were the forceful actions, Jay, that you and the Federal Reserve took through the use of your liquidity tools, including the creation of the Bank Term Funding Program. However, in deploying these liquidity tools, that has come at, against this backdrop where the preeminent monetary policy concern is high inflation. And that's, of course, a little different from some of the earlier episodes, and has raised renewed discussions about the so-called
At the same time, Yellen's over here telling CEOs more bank mergers will be necessary. Yeah, because the Treasury can't support another failure.
Tools and liquidity tools, as opposed to more traditional monetary policy tools, and how they fit together.
It's an interesting question, but I want to start by saying, though, that the overall, the banks and the banking system are strong and resilient and well positioned to deal with the challenges they may face now or in the future. So, as you pointed out, we do have separate tools: monetary policy to achieve our macroeconomic objectives, liquidity, supervisory, and regulatory tools to address financial stability issues. But I see an important distinction between separation. This is the separation principle: separation and independence. Our tools can have separate objectives, but their effects are often not entirely independent. So the tools are complementary almost all of the time because financial and macroeconomic stability are so deeply intertwined. In fact, our consensus statement notes that sustainably achieving maximum employment and price stability depends on a stable financial system. So because they're so intertwined, to me, there is not likely to be an absolute and complete separation of the tools, nor is that possible or desirable. And I think as Ben's research and the global financial crisis demonstrated,
Is bank
financial
not
stability
as strong
affects
and resilient
macroeconomic
as
stability
JPAD
and
just
vice
mentioned?
versa. We saw that clearly at the outset of the pandemic. As a result, the tools
that's
that we use
awkward.
to address concerns in either arena can and will affect both, especially during extreme circumstances. That said, yes, the tools are separate. They have individual purposes, and most of the time, each can be used for its intended
My
purpose.
stream keeps
without
buffering.
compromising-
Everyone liked the
compromising
stream.
the
If you
other.
guys could drop a
For
like,
example,
I appreciate
as
it.
you pointed out, when banking stresses emerged in early March, we used our liquidity tools, discount window, and the Bank Term Funding Program to make liquidity available to banks that might need it.
Yep, and then
that
you pulled it back.
liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and
Credit
are likely
crunch.
to weigh on economic
Say it,
growth,
say credit
hiring, and
crunch.
inflation. So as a result,
No, no,
the
no, no.
policy rate
That's not the word.
may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain. So.
Thank you.
How do you know it doesn't
And of
need to
course, that-
rise to meet
I
your
think the
goals
effectiveness
if
of
it's
those tools
uncertain?
is reflected in the fact that the FOMC has
Say
actually
credit
raised
crunch.
interest rates twice
Someone
since
say
the
it.
emergence
It's
of the
true.
banking strains.
What about all the
Of course,
bankruptcies
the
this
purpose of
week,
that is
Jerome?
to confront the inflation issue, which brings us to our next topic, which is in fact inflation. In the pandemic and the aftermath, we've had many renewed discussions of the important and classic textbook distinction between supply shocks and demand shocks, and in particular, the particular challenges that a supply shock can present to a central bank. And that's also raised a lot of questions in academia and in policy circles as to whether or not the inflation process post-pandemic
I'm not
is
gonna
going to
ban
look
you, Dan,
quite different
because-
than prior. Jay, maybe we can start with you. A number of folks have argued that we are entering a new period where supply shocks will be more frequent. Would love to hear your views on whether you think that's a possibility and what that might mean for central banks.
So it's a great question, and it's one I think we'll be dealing with for quite a long time. And I'd say it's certainly possible that we'll see continued supply shocks. I also think it's just very hard to forecast that with any confidence. As Yogi Berra is thought to have said, Ben, you're the baseball expert, you can confirm or deny this, but it is difficult to make predictions, especially about the future. So I think that the best we can do at this stage is probably to just identify the factors that we think can lead to further negative supply shocks. I will say that, though, that positive supply shocks related to globalization largely probably contributed significantly to the period of low inflation that either ended or was interrupted by the onset of the pandemic. And I'm thinking there of the vast increase in global labor supply, the development of efficient global supply chains, facilitated by technological advances and things like that. And I would say those positive supply shocks do not seem likely to be repeated. At the same time, the drivers of the current inflationary surge certainly included a sequence of large negative supply shocks to the global supply chain for goods, which also experienced a large and persistent shift in demand from services to goods, and also the supply of workers. On top of that, Russia's war against Ukraine brought further shocks to global supply chains, particularly supplies of energy and non-energy commodities. So we can't know how persistent those shocks will be or whether further negative supply shocks will come along. Will globalization be partially or fully halted or reversed? Will it resume again as the pandemic mercifully recedes into memory? We can't really know that now. But for policymakers, the bottom line is that central banks will continue to be responsible for providing price stability, and that will require us to navigate whatever additional supply shocks do occur. So as Tomas and Ben and their co-authors wrote in the inflation targeting book, what a central bank can do is control inflation. And that is true over time, even in the presence of supply shocks, should they come.
Ben, would love to hear your views on this.
So unusual events which disrupt normal economic functioning often are followed by inflation. Examples are World War I, World War II, the Korean War, and now the pandemic. And the pandemic just makes it harder for policymakers to understand what's happening and to react appropriately. And in particular, the pandemic scrambled the labor market, made it harder to judge the state of the labor market. The opening led to a very extended rise in commodity prices.
Anytime there's bank
to deal with, we had supply chain issues, which was pretty much a new thing, which was also a contributor to inflation. So there are many features of the pandemic that made this an unusual episode and a difficult episode to address. That being said, I think that, and I've done some research on this with Olivier Blanchard that we're presenting next week.
No one cares about your
the
papers.
basic mechanisms, I think, are still the same.
Philosophist.
But you have a bunch of bad shocks, that's going to give you a problem. But the underlying mechanisms of supply shocks and tight labor markets and so on are really the same. So I think, I don't think there's been a major change in the underlying process that generates inflation, only a series of shocks related to the pandemic that gave us this episode. Going forward, I agree with Jay that we can't predict, what new shocks will come. We've got new technologies out there.
You can't call it an unusual event. It's called World War II. It was a sequel. A new Guardians of the Galaxy is not an unusual event.
That might affect the price and availability of fossil fuels. And so there are many, many things that we can't predict. But I think that broadly speaking that the inflation process has not changed, and it's one aspect of that, which is very good news, is that the Federal Reserve's credibility has helped keep inflation expectations, particularly longer-term inflation expectations, reasonably well anchored, which is always sort of the first step in getting control of inflation.
You mentioned the role of the labor market tightness in the inflation process. I think it's quite striking that right on the eve of the pandemic, the unemployment rate was around 3.5%, a 5-decade low. Yet at the same time, inflation was kind of struggling to get up to 2% on a sustained basis. Here we are in 2023. The unemployment rate is roughly at the same level as it was prior to the pandemic, but of course inflation is far above 2%. So in that context, should we be thinking about the relationship between slack in the labor market and inflation differently? Do we not have the right measures of slack? Is it the problems with understanding what the natural rate of unemployment is? Or is slack really not the key to understanding inflation in the first place? Ben, you want to take that one first?
As I was talking about before, I think that the pandemic, to some extent, scrambled the usual signals from the labor market. And the Federal Reserve over time has begun to put more weight on things like the vacancy to unemployment ratio, which seems to give a better signal in a period of change.
A little deeper on the chain. 4,200 is still pretty strong on the call
labor market
side.
Matching process is in change.
They're still stabilizing price in this range, but
there has been some scrambling.
puts are coming in out of the money.
Signals.
Quite a lot of them.
That being said, it's
as you can see,
simply
in just
not
these
true
two
that,
contracts,
even
right?
in people who understood since the 70s,
climbing pretty rapidly.
that there's not a simple inverse relationship between inflation and unemployment.
At the strike.
In particular, what can break that relationship is supply
41.75,
shocks.
41.70 especially.
During the 70s,
some
we didn't
puts
particularly
coming
have
in at
tight labor
4,200.
markets most of the time. We had high inflation,
Some
because
calls selling
we had
off
oil
in the
price
money,
shocks,
41.80 through
which the Fed did not
41.95.
respond to adequately. B, because inflation expectations were not well anchored, and there was a strong tendency for price increases to feed into wage increases, to feed into price increases. So because of the presence of supply shocks and inflation expectations dynamics, there's no reason why low unemployment and high inflation can't coexist. But the remedies might be, depending on the situation, might be somewhat different.
Jay, how are you thinking about that?
So I'm very much in agreement with that. It's certainly true that we had both before and after the pandemic unemployment very low, close to 3.5%, but that we only had high inflation after the pandemic. Does that mean that our understanding of the relationship between slack and inflation is badly wrong, or that it has changed fundamentally after the pandemic? And my answer would be tentatively no to both of those questions. I think what really is different this time was the series of unexpected and persistent supply shocks that featured in the inflation process. I don't think labor market slack was a particularly important feature of inflation when it first spiked in spring of 2021. By contrast, I do think that labor market slack is likely to be an increasingly important factor in inflation going forward. In particular, inflation in non-housing services is showing signs of real persistent. In this highly diverse sector, labor costs are a high proportion of total costs, and that sector happens to account for more than half of the core PCE index. But all of this, the point is, all of this can be explained, I think, using our standard framework for understanding labor market slack. You could say it this way, that the natural rate of employment probably rose sharply as the pandemic severely disrupted the labor market. And the implication of that
they're not
would be
long
that,
dated,
say,
but they're there.
an unemployment rate of, say, 4% indicated a much tighter labor market in 2021 than it did in 2018. And as Ben mentioned, of course, after the pandemic, we began looking at much more closely at alternative measures, particularly vacancies, but also quits, which have been signaling even greater tightness than the unemployment rate alone might have thought to have been to signal. I mean, to put some numbers on it, we at the end of 2018 and the end of 2021, we had 4% roughly unemployment in both cases. In 2018, the vacancies to unemployment ratio was 1-to-1 essentially. In 2021, it was 2-to-1. And that was a much better indicator, obviously, at that time of the simple standalone unemployment rate. Although, as I mentioned, you could also think of it as the natural rate being highly elevated. The other thing is, it may also be the case that the Phillips curve has steepened, meaning that inflation has returned, at least for now, to being more responsive to changes in the labor market slack.
Yeah, I don't think
the Phillips curve
unemployed day traders are
was once thought to be fairly steep
portion
after
of the
flattening.
population,
Relationships in the economy, like the Phillips curve, evolve over time, so I would not characterize that as a problem for our understanding of inflation.
I think the gig economy is probably
Very good, thank you.
a much bigger
Maybe we
factor.
can pivot here to the topic of central bank communications. It's widely understood now that the better the
It's
public
going to hug the
understands,
4,200 line
the
until
conduct
something
of
gives.
monetary policy, the more effective it will be. But fostering that type of understanding really requires a lot of communications, and of course that can be hard. Both of you have been powerful advocates for advancing monetary policy communications, both with an eye toward making policy more effective, but also for the purposes of promoting transparency and accountability. Ben, you've obviously played a critical role here, advancing the FOMC's communications, including the introduction of press conferences after FOMC meetings, the introduction of the summary of economic projections. So what changes over this period since the communication, say, revolution began, would you highlight as being some of the most effective, most important, and where do some remaining challenges exist?
Well, let me talk about communication, because I think you need to understand that it serves multiple purposes. I mean, one of its purposes, the narrow purpose, is to try to align market expectations with the Fed's own thinking. I think that goes back to Alan Greenspan. If you go back to 1994, the first FOMC statement. I mean, since then, the Fed has tried at least to give some indication.
We're starting to lose ground
of
on
what it's thinking,
4,200.
what it sees as the risks to the economy. But beyond that, you mentioned transparency and accountability. This is a powerful institution. It's very important that it be accountable to the Congress and to the public, and best way to do that is explain what we think, what we're doing, and how we're going to go about that. There's other reasons for communication. One I would talk about is feedback. We're having a conference here. If the Fed puts out the issues that it's concerned about, economists will write articles or tweet and respond to that. Or in the case of the Fed Listens program, maybe it would be more ordinary people who are explaining how monetary policy affects them. One final thing I would mention is diversity of views. Because the Fed has a consensus culture, and there are very few dissents normally, the outside perception is the Fed is subject to groupthink, which of course is possible, but with people talking about their own views and explaining why they see the economy as they do, it does, I think, at least to some extent, show that there is a range of opinion on the committee. In terms of tools, I guess I do feel proud about the press conferences, which I introduced 4 times a year after the Summary of Economic Projections, in which Chair Powell has taken to an art form.
That's interesting.
And the
Future
I
is
think
not
also,
so confident.
just the inflation target, the forecasts that we release, and there's a cultural change, which some people don't like, but I think on net is good, which is, it used to be, if you look back at speeches in the Greenspan era, the president of the Federal Reserve Bank of Minneapolis, would talk about, harvests or something, wouldn't talk very much about the global or national economy. Now you have a lot of people talking
But they're
about,
laughing and smiling
different aspects of the
because
Federal
they
Reserve's
sold
views.
in November
And,
2021.
again, that contributes to both market transparency and also to accountability to the local constituency and to the national constituency.
Jay, you of course have continued to push forward on the communications and transparency fronts. Welcome your thoughts.
I think the broader setting is that transparency is especially important today. Polling data show that many important public and private institutions globally have struggled to retain the public's trust and support in recent years. Now, we're an institution that serves a critical public mission, but to be here and work here is to know that the particulars of what we do and how we do it are not generally top of mind for most people. And on top of that, we have a critical and a rare grant of independence. And all of that, to me, means that we have a special obligation to explain ourselves clearly, what we do, why we do it, to provide transparency to the public and their elected representatives in Congress so that we can earn and deserve their trust and support. And that's a
Beat the
critical
busy bee.
task
Welcome
if
to
we are gonna
Zillionaire, man.
sustain
I'll play you
our
a
democratic
song after
legitimacy
if you
through
remind
this-
me.
this,
Hit me up on the
interesting
Discord. I'll get you
period.
added after the stream.
My colleagues and I really take that as a primary and affirmative, proactive obligation and not something we see as a burden or of second-order importance. So in that spirit, to your point, We have followed the example of Chairman
Some
Greenspan
out-of-the-money
beginning
calls
in
selling
1994
off,
with the
but
first
still some
post-meeting
defense,
statement,
4180,
through Ben's,
85, 4200 still
innovations and Janet
stacked.
as well, in looking to foster greater
But
transparency and
put
accountability.
buying
A
is
couple of
increasing at
examples.
a
We now do a press
rapid
conference
rate.
after every meeting, not just every other one. We have greatly expanded our congressional outreach to be certain that we hear directly from lawmakers on an ongoing basis.
VIX still
so
low,
that
but one
they-
day VIX
and
is
also so
not.
that they have the information that they need to conduct appropriate oversight. As I
Banks
mentioned,
turning down
in
again.
2019 and 20, we conducted a public review
VIX
of our
one day
monetary
at-
policy framework, seeking input
not
from a
all-time
broad range
highs,
of people and groups all around the
3-day
country.
highs,
We've also
4-day,
significantly
5,
expanded
5-day
transparency
highs.
beyond monetary policy. For example, we now publish semi-annual financial stability and supervision and regulation reports. Of course, there are always communication challenges, especially I find about communicating the uncertainty that attends our assessments of economic conditions and the outlook. The good example of this is, despite our persistent efforts to explain otherwise, the policy paths from the SEP seem regularly to be taken as a firm plan or a committee decision, rather than what they are, which is a compilation of individual participants' best assessments on a particular day of appropriate policy under the assumption that conditions evolve in line with their baseline forecasts. So that's just a challenge that we constantly face in the context of great uncertainty. Despite that, I would say, though, that the summary of economic projections has actually been very useful during this tightening cycle, as markets have looked ahead and priced in future rate hikes, long before they're actually implemented.
Your last point really brings up the idea of communications as being an effective policy tool. And I guess the key element of that is the use of forward guidance. Jay, in one school of thought, forward guidance is a tool that should really only be deployed when interest rates are at the effective lower bound. And so you can no longer provide accommodation by lowering rates further, and so you do so through communicating about the policy path in the future. But another school of thought, forward guidance should be just a regular part of communicating with the public to convey the committee's policy intentions, even far away from the effective lower bound. Where do you come out in that debate?
Well, I do think it depends on circumstances. I do think that forward guidance can be useful when policymakers have a materially different or clearer view of the likely path of policy than does the interested public. I would agree at the effective lower bound when we need to provide more stimulus by indicating an intent to keep policy accommodative longer than the public expects. There's a use case there. I also would say, though, that communication comes with a cost of misinterpretation, and it also may limit flexibility. So I think we should use forward guidance sparingly when the course of policy is either reasonably well understood or, on the contrary, is so dependent on uncertain future developments that little really can be said constructively about the future. And a good example of that was the March 2020 FOMC meeting. The pandemic shutdowns were just beginning. The level of certainty was almost unimaginable, and we chose not
last line of
to issue an
defense on
SEP
the call
at
side.
that point. Really, our view was that releasing a forecast
Below
at that time
4180.
might have been more of an obstacle to clear communication than a help. In contrast, as I mentioned a minute ago, forward guidance has really been a useful and effective tool during the current tightening cycle, as financial conditions have tightened well in advance of actual rate increases. The 2-year tightened between the September 21 meeting and liftoff in March of 20. It tightened by 200 basis points before we ever
Futures
actually lifted
testing 4200
rates, and
right
that's
now.
significantly because of our communication. So in the current context, until recently, it's been relatively clear that further policy firming would be warranted, and our forward guidance has said so. Now, however, we've come a long way in policy tightening, and the stance of policy is restrictive, and we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent banking stresses. So today, our guidance is limited to identifying the factors we'll be monitoring as we assess the extent to which additional policy firming may be appropriate to return inflation to 2% over time. As I noted at the last press conference, that assessment will be an ongoing one as we move ahead, meeting by meeting. Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
Thank you. Jay, you mentioned that guidance can be useful at times when the public may expect a very different policy path than policymakers. How do you think about those sorts of situations?
You're right. So recently, it has sometimes been the case that markets
What
appear
is
to be
forward
pricing a different
guidance?
rate path than the committee expects would be appropriate. But
GOP
I would say that
halted debt ceiling
disconnect
talks.
does not seem to reflect a
Bullish.
misunderstanding of our reaction function or a lack of belief that we'll do what's necessary to bring inflation down. Rather, it appears to reflect simply a different forecast. One
Time
in
to
which
price up those
inflation comes
CDS.
down much more quickly than the committee.
Treasury failing this
committee
weekend?
participants think is most likely.
Credit downgrade by
perhaps due to a
Monday?
significant downturn. I would say also
The
so far,
Bernanke
data
effect.
have continued to support the committee's view that bringing inflation down will take some time. Moreover, something we often don't remember to think about is that market prices always
Yeah,
reflect
it's
both
bearish as fuck.
expectations and compensation for risk. And what
It's also just political grandstanding and drama, but
expectations is actually closer
they're
to
picking the
views in
wrong time to
S&P
play their game.
than what is reflected in market
Treasury
pricing.
General account.
So ultimately, my colleagues and
Tuesday's
I have our
close
forecasts,
was
and market
$67
participants
billion.
have theirs. Our role is not to
I don't even know if
advocate
that's
our
enough for
forecast.
payroll.
What we can do is be clear about our expectations for growth, unemployment, and inflation, and the likely implications for policy. As well, we want the public to understand how policy would react if the path of the economy were to differ materially from our expectations. And of course, we do lay out our individual forecasts quarterly.
Ben, what would your takeaways be for the past couple of decades' use of forward guidance as a policy tool?
Well, Charlie Evans and co-authors have made a useful
I do
distinction
see
between what they
gold.
call
I have a
Odyssean
pretty
and
large
Delphic
position
forward
in it.
guidance. So Odyssean
Futures
forward
now
guidance
down below
is a commitment
4,200.
forward guidance, which is rarely used, but
The next
typically at
relevant
lower bound,
resistance,
where
4175.
the central bank promises to do something, and its credibility on the line, that it will follow a certain path going forward, and that's a way of getting more stimulus. And I think, again, that goes back, again, to Alan Greenspan, I think, to indicate that a certain path was very likely, and that actually helps achieve the objectives. Delphic forward guidance is basically just a forecast. Here's what we think. Tomorrow we might think something different, but we're just trying to, as part of our transparency, we're just trying to give you a sense of where the economy is going and how we think policy will react. Now, as Jay points out, there are some problems in practice. One is people don't understand the difference all the time between a commitment and a forecast. That's something that Jay has emphasized, and I think that should be emphasized. Another is people underestimate the amount of uncertainty involved, which is enormous. So I don't think you can do without some form of forward guidance, because the idea of transparency says, here's what we see, and here's why we're thinking. And so the idea that there's no guidance at all, most of the time, I take March 2020 as a counterexample, but most of the time you do want to give at least a sense of where you think the economy and accordingly policy are heading. I think, just if I might editorialize one more minute, I think one of the issues is that the FOMC is so large and geographically dispersed that it's been difficult to come up with a collective committee forecast. We tried to do that when I was chair. The dot plot is a compromise, which is not ideal. Other central banks do other things. Sometimes they have collective committee forecasts that are voted on, or they use market rates, or they publish the staff forecast. So there are different ways to go about this. But again, I think that forward guidance is both an instrumental tool, but again, letting people know sort of how the central bank sees the evolving situation, even if there's lots of uncertainty, which you can say, normally is part of transparency.
So you highlighted uncertainty as being a key factor in dealing with some of these issues. Obviously, uncertainty is a pervasive feature of monetary policy making, and often invokes the so-called risk management approach to making monetary policy. Maybe we can start, Jay, with you on this topic. The FOMC's raised the federal funds rate by 5 percentage points in a little more than a year. That's a very rapid pace by historical standards, as we all know. How do you view those actions in the context of the uncertainties that you and the committee faced about the economic outlook, and how did risk management considerations factor into your decisions?
So I'll start by remembering that Alan Greenspan famously said that pervasive uncertainty was the defining characteristic of the policy landscape.
SG expense is
It's worth remembering that he
$41.75. Is it
made
worth
that
it just giving
comment
out
during
or
what
setting
we
a
now think of
stop?
as the
It's probably
Great
worth it to set a stop, right?
So that statement has never been more
What is a
apt
good
than it is
spread
today.
for a trail?
If you look back, the pandemic, the global
you
shutdown,
definitely
the historically forceful response and the reopening.
I don't
all
know,
of
maybe
that had
like
no modern
2.5,
precedent. So
5%
it has been
of
a time
premium?
of historically elevated uncertainty.
If it's got a-
and of
oh,
unexpected
for the
outcomes.
trail?
No advanced economy had ever faced a shutdown and a reopening, and now
I don't know.
all of them
that
would
depends
face
on
it at
your
the
own
same
risk
time.
for
So
the,
no matter
the
what
premium.
happened, the outcome was
How
going to
much
be
risk are you willing to
unprecedented.
take on your
So this
profitability?
level of uncertainty posed real challenges
Generally,
for policy
like-
and policy communications. On the one hand,
Depending
we
on the
wanted to
price
be-
of the
we had to be
contract,
nimble to
if
be
it's a
able
higher
to
price contract,
respond to
then
the evolving
like
situation.
5%
On the other hand,
of
we wanted to be as
premium
clear
is
as
more
possible
than
about
sufficient.
what we were doing, lest we add to uncertainty. So I would say policy certainly has been nimble.
But 10 is also viable.
Consistent with what were then our expectations, the data did actually show declining inflation through September of 2021, but then turned decisively against that expectations thereafter. And in response, we accelerated our policy firming, ultimately, as you noted, raising rates by 500 basis points in just over a year. Over this period, we communicated that the object was to reach a stance of policy that is sufficiently restrictive to return inflation to 2% over time. But we also communicated that the level of rates that would ultimately be required was highly uncertain. Now, until very recently, it's been clear that further policy firming would be required. As policy has become more restricted, the risks of doing too much versus doing too little are becoming more balanced, and our policy has adjusted to reflect that fact. So we haven't made any decisions about the extent to which additional policy firming will be appropriate, but given how far we've come, as I noted, we can afford to look at the data and the evolving outlook and make careful assessments.
Ben, when you became a policymaker, you were
But
well
interest at
versed in some of the academic
41.75,
literature on
41.70
Yeah, I
is
moved from
picking
that
up
side to this
a
side.
lot. And the gamma on
I
it's
think
also
uncertainty when
growing.
you're an academic is trying to decide whether your error term is Gaussian or not. In actual policy making, you don't even know what the current quarter GDP is, because it's going to get revised, several times down the road. I remember when I was sitting just as a member of the board, and Greenspan was in the chair, and we had responded to some inflation data, and a little bit later, it turned out that inflation
Sorry, 1 second,
change
I'm
had
just
been
checking.
revised away. And I asked the chair, do you think we can revise our interest rate policy? It is very difficult. I mean, got to laugh with that, but just trying
bounce
to make
looks
policy, it
short-lived.
involves not just uncertainty about, the data, about the model, about all the things that can
41.90.
happen, about the
That's where
social
the
and
support
economic and
was found
political
here,
environment.
but it looks weak.
So it's very difficult, and unfortunately, or fortunately, given that monetary policy works with a lag, given that there are risks on both sides of the modal forecast, there's not much choice but just to accept that uncertainty and try and do the best you can, being ready to adjust as new information arrives.
Very good, thank you. We are getting close to the end of our allotted time. Maybe we could wrap up with just a question looking ahead. Jay, maybe we can start with you. What would you point to as some of the key issues that will be most relevant to the research community as well as to the policymaking community?
So I guess I would start with the labor market, and what we talked about earlier of vacancies in particular, and the beverage curve, and the whole discussion over whether the extraordinarily high level of surplus demand in the labor market can be lessened through the vacancies channel without a significant increase in unemployment. That would be more akin to what has happened in all prior cycles, or most prior cycles. So that's going to be a question that we will resolve empirically, but I think we're learning new things about the workings of the labor market, at least in this one situation. I think on monetary policy, it's going to be interesting to look back and try to understand how inflation spread from what was at the beginning, very focused on the goods sector due to the rotation of demand from services to goods, and the tremendous amount of support that goods purchases got from fiscal and monetary stimulus. How did it spread then through really into the service sector, where it now significantly resides? I think we're seeing much progress on goods, and we have progress in the pipeline on housing services, but where we see persistent inflation is now in the service sector. So what is the mechanism by which that happens, and what are the implications?
Ben, you have the last word.
Well, I think one of the things that I would urge researchers to look at is the relationship between monetary policy and financial stability. A very, very difficult relationship. If you read the papers, you see that everybody has a very strong opinion about this subject, but they don't necessarily correlate. As Mark Twain once said, the things you don't know can hurt you as much as the things that you know for sure but ain't so. You know, I think that we really do not understand, to the extent that we need to, the relationship between different aspects of monetary policy, risk-taking, balance sheet behavior, et cetera.
Futures are bouncing a little, but it looks weak.
It's just something, there's a lot of good work being done, don't get me wrong. But I think we need to understand much better, you know, what the channels are and to quantify the relationship so that we can think about to what extent we need to take that into account in monetary policy.
Very good. Well, let me thank both of you tremendously for sharing your perspectives with us today. It's been a highlight of our conference honoring Thomas Lobach, and so thank you very much. Round of applause.
So, not a lot said. Some nice profits on 0 DTEs there, but we'll see how this turns. They're definitely going to go back and get those 4,200 calls. There's no fucking way they leave them behind. There's still a shitload of them. Oh, they're going to leave them behind? You think so? I think we at least test 42. I think they'll push for that at a bare minimum. Ben's sweating and sounding this way because he was told to say bearish shit and he knows exactly what he's doing. Probably. Oh, billionaire guy. Thank you, by the way. When do the 4200s expire? Today? Most of them, yeah. There's some for 616. But probably just bought at that date for the Delta more than anything. It's ridiculous, really, but let's see what happens next week. I mean, today's far from over still. The entire meeting was had other events going on in the background, right? Yellen announced that more bank mergers would be necessary. I don't know if she added the caveat that the Treasury can't sustain another bank failure right now, but based on its current balance sheet, it cannot. At least not any significantly sized bank, like no medium or mega regionals or whatever they want to call them, super regionals. If any of those were to fail in the next 2 weeks, the Treasury couldn't support the failure. And then I guess the speaker walked out on the debt negotiations, which is just more grandstanding, you know. But they've picked a poor time to grandstand and fight for the debt ceiling. Unless they're going to grant the Treasury an extension. The problem being is it takes a few days to grant that extension to the Treasury. Yeah, SPX, well, it's down 15 BPS so far, but yeah, it's not dropped much. Although from our high of the day, we're down more than that. We're down 15 BPS from yesterday's close. Big future sell-off incoming. I agree. If your objective is to bring the markets down, then you could argue they picked the perfect time to grandstand. Possibly.
Yeah. Although that's crediting them with a lot of knowledge, I don't think they have. If you've ever watched a House Financial Services Committee meeting, you would know that basically no Congress people have any fucking clue what's going on in finance. Except Pelosi and her husband. Listen, Greg, I just want to give you the heads up right now. My birthday is in November. I just want to make sure you get enough theta on my gift. My birthday is also in November. Are you going to name your unborn child after me this year? Down to 4175, and they can grab their 4200s. Yeah. Call it a wash then. I unironically think that I even I have more knowledge about the market and life in general than some of our representatives. I you know what, Half Squirt, I would as much as I hate you, I would elect you before many of them. No more little Kirks for old bear. You missed the J-Pow speech. Walken or Dianne Feinstein? Feinstein. Yeah. No, still Feinstein. Believe it or not. Walken should not have any power. Nope, that's not true, Venseg. I hate Half Squirt. I hate him with a burning passion. What happened to the option chain for DDS? Nothing past today's date. I never said anything. I'm going to take this opportunity to say I never said anything about DDS. I have not been providing any information about DDS. My exposure to DDS is my own business. None of yours. And no, it doesn't have an options chain after today. Hate and love are two sides of the same coin, but they're different sides. Hey, boss, I cut the power to Watkins' house. Just like you said. Now what? Run away before he shoots you. Walken is special, live in Gork head rent free. AI. Oh, he's not special. You think you can enlighten me as why the options chain is disappearing for DDS? There's no reason to make a market on it. The options chain has been illiquid as fuck for 3 years. No one wants to take the risk. Its options chain ends soon. What does that mean for my stock? EET? Don't look at it, please. I don't know, man. What can you please say about... Can you please say something about DDS now? No. I have no comments on DDS. Should we reset SLD expectations at 2 to 3% of 4,200? Yes, I still believe. You could. I think it's interesting that MMs would walk away from providing options. It's really not. It happens all the time. The stock is extremely illiquid, which makes it very difficult for a market maker to hedge. I mean, there hasn't been any like anybody like making a liquid market on DDS. You know, as long as I've traded it, even when it was cheap, the options market on it was meh. Like back in 2020, it was still like not very impressive. Can you comment this way? I had VIX open so we could watch it with JPOW in the corner. Hold on. I need to watch this call positioning. 42.20, 25 falling off a little bit. 41.75, 41.70 picking up. Although those could be sold. However, VIX is rising, so I need to look at the one-day VIX. One-day VIX fell off a little bit, but now it's picking back up again. Maybe this fails. It doesn't look so hot. Although I don't think the momentum's great. I need to see what's moving on longer dated positioning though. I'm doing alright, Mr. Gould. Thanks for asking. So 4200's really the key strike here. The 150 million gamma. Positive. Price action into the weekend's starting to look, well, moderately bearish. I wouldn't say it's significant. Although there's quite a lot of room for downside here. It's possible we see more chop. I don't see any big movements in the positioning right now. Call profitability is declining a bit. Not much, though. ES moving to retest 4200 after the bounce. A breakdown on ES could be significant here. And there was some decent volume on the rejection. So keep your eyes open on that, I guess. Yeah, I know. Yellen told banks that mergers may be necessary. You mentioned yesterday that getting underwater positions out from NVIDIA is a difficult task. Selling puts on NVIDIA doesn't make sense since premiums are bad. Bear call spreads the only way. I mean, bear call spreads are a way. That's primarily what I've been using, but I've also been, on my open puts, I'm selling theta. Even though the value's shit, right? It still offsets the decay enough nominally, but marginally. The big banks, we at the big banks would like to extend our gratitude for holding our bags for what has felt like quite some time, just a bit longer. 2.2 quake in New York. I didn't feel shit. Some of these calls are selling off at 4,200. Are they? Maybe a little. Calls are increasing, or puts are increasing at 4170 and 4175. But they're still protecting. They're protecting gamma neutral. But I think it shows a little more fear on the bull side. The fact that they've been buying in the money calls at 4150. Either that or the bears are super fucking bearish and they're selling 4150 and buying 4175. Hold on one second. I'm trying to find. Okay. See, out of the money calls increasing a bit. This still, I don't know. This still looks kind of choppy. I think still heavily reliant on futures here. Oil's down. Dollar's down today. 42 BPS. BTC moving up a little. Gold's moving up. 80 BPS so far. Silver moving up a little. NASDAQ down 30 points. Russell 90. VIX is up 2.6 or 263. VIX futures are up 289. So VIX futures are climbing. That's a good sign. There's still a crazy spread between VIX futures and spot VIX. And we're less than a month from expiration. Amused, welcome to Dillionaire, man. Thank you so much. Hit me up on the Discord. I'll get you added to the country club after the stream, dude. Moderately bearish linguistic equivalent of there's a sense in which. Keep going, I'm almost there. You know what bulls hate more than anything? Music that includes dancing bears. I know. But gamma neutral, right? Rims and Tims? I love tempered bearish sentiment from Gurk. My sentiment's generally pretty tempered. How much more psychological is the 40-20 psychological level psychologically? Because 40-20 lit, fam. No one cares what fucking shitty retail options people buy. The more 40-20 calls Wall Street Bets buys on SPY, the more likely the market is to crash. Any thoughts on when NVIDIA might do their shelf offer? You mean complete it? I don't know. I'm surprised they haven't announced that it's completed already. Their valuations are fucking ridiculous. We should chop then drop, right? I'm really trying to work on being your new nemesis, but I find you too huggable. I know. Do you still have your June 16 4000s? Yep. I bought some more. Why are they offering shelves? IKEA will crush them in that market. Well, they're not selling video cards, so they've got to try something, right? Volgavana White. NVIDIA going to hold out on completing their share offering until 500, then sell at the bottom. For now, it's okay to wait for earnings spike before selling CC. I rolled my put credit spreads for GME and Time. XD. Yeah, I mean, you could wait. I mean, IV's crushing out on GameStop right now, so any chance GME to 21 today? It's looking better. 21 like 80 could get hung up a little bit. There's some resistance there, so watch that. But I wouldn't sell zero DTEs at 21. That's like you're gonna get assigned probably if you try that. Is GME's borrow rate going up? Is anyone looking at that right now? I don't have Fidelity open. Is it up this morning? No, just flat this morning. Down from 2 days ago. I'm sorry, borrow rate's dropping too. It's kind of bearish for both of them. Yeah, it's pretty flat. Big drop coming. I feel it. Big repositioning here, I think. Yeah. I hope that leads to a drop. Futures looks like it wants to sell off. I'm starting to see some pretty big blocks out of the money. Got any more of them Volkers? I don't really. I think we have some more Fed speeches today. I think nope, we're all done with them. The other two were this morning in the pre-market. So the only thing else coming in today are the rig counts. Baker Hughes. It might have some effect on the price of oil, but that's about it for today. Monday is pretty bereft of data too. And then Tuesday we start moving back into more and more data and into the rest of next week. Next week's going to be a little more data heavy. But Monday's still very light. Bye GameStop. I mean, still still very illiquid. Easy to short, easy to drop the price with not a lot of liquidity, but still very illiquid. There's been no significant liquidity resolution here. Give the market time. Hmm. Target took a little slide today. Jimmy is with them. Did anyone get a count on the number of times which they said uncertainty in that talk? I wasn't listening, but couldn't watch. I didn't personally, but it was more than 10. I think these 4150 P0 DTs are going to go in the money. I mean, it's risky. You're targeting a range right below gamma neutral. They may not in the intraday, but they could go up in value. I still think that they're going to try to get their calls at a bare minimum. I'm still a little cautious. I would there's still a lot of 4200 calls. Like the upper strikes are starting to get weaker. Like 4205, 4210. Those are starting to give up a little ground. And 4175 and 4170 put interest is increasing fairly consistently, but there's still enough call interest between like 4180 and 4190 to sustain one last push to 4200, right? And so if the put side gives any ground here, I think it can briefly bounce. So just be wary of that. There's a little bit more of a battle going on today than there was yesterday. The longer term time frames do look pretty bearish though. You piling into puts is not going to change the direction of the SPX. I admit, I'm here to watch those 40/50s you bought weeks ago for today go green. That's very, very unlikely. That was kind of just a YOLO if it smashed down in the early part of SLD. It didn't, but... You think we see sub 18 on Jimmy before June OPEX? That's possible. I think we could still run for May OPEX. Like, say we drop today, Monday, really hard on SPX, right? And then we see a like market bounce on OPEX like T+2. I think GME could run in that window. I don't know how hard, but maybe a little. Gamma Max seems tough with most of Gamma Max being on the back of short calls. Volatility is not very high. SLD is a myth. It's a consistent one. Monday morning at market open. $4,200 SPX. Futures are at 4,200 right now. Futures are selling off a little. We're still just chilling at resistance though. It's consolidating. This should technically be bearish, right? But yep, there's a push. I still think they want those calls. That's too much money to leave behind. I mean, yeah, it could fail, but I don't think it will. Even if we give it like a lot of room, like move out to the wicks. That's why technical analysis isn't always the most useful thing. Because it ignores like short dated positioning in favor, like longer term trends are more accurate, but outside of that, yeah. Buying calls because bearish means bullish and bizarro weak. They didn't bring this up from the lows on Monday to just give up here. Really? Have they? Well, let me ask you another question. Have they ever been able to sustain a pump longer than 2 days in the last 8 months? Like a consistent, like 100 BPS a day pump? Even after they got all the free liquidity from the banks, it was the pump was pretty short lived. If they can't save them and they capitulate big downs, yeah, that's a shitload of delta. ES levels are pretty helpful, even daily though. Yeah, no, ES levels are very helpful. Yeah, I mean, ES is far more money going, like it's far more liquid and has far more money going into it than SPX even does. What about early April? Pajama Samurai? They wouldn't just capitulate though. No, yeah, they'd reposition. What do you think of Nvidia earning next Wednesday, the start of OPEX? Have you had time to analyze the data? Thanks. I think they're going to have a very hard time meeting their own projection of 8% growth quarter over quarter. They're going to say AI a bunch and talk about products that they're making that no one's buying yet, but I don't know if that'll be enough. Also, next quarter is Nvidia's not on the same quarterly schedule as like most of the other tech companies. Next quarter, Nvidia is reporting their quarter one earnings, which I believe is going to be the first earnings where they're reporting the cutoff from the sales to China. Because don't forget that there was not an embargo, but an executive order that halted the sale of like AI chips to China. It's worth mentioning that the money from SPX options goes into and out of ES as well as SPY. Yeah. And the underlying and everywhere. But ES is the simplest and easiest way to hedge big options buys. Yep. Market makers use ES very heavily, right? Like market makers on SPX. Ivy will crush, so your put and call will both be less value, so not a good idea, I reckon. What's this? My Upstart 1250 CSP May 19 I sold is worthless now. I should have bought shares. LOL. I'm theta gang now, losing out on more money. Upstart 1250 May 19 CSP is worth. I mean, that's the idea behind selling a CSP, right? You want it to be worthless? You could have gone synthetic long at when you. I mean, when did you sell it? Did you? If you sold it like at the beginning of May, right? Then you could have used that money to buy, like you use the credit to buy calls. If you weren't holding NVIDIA yet, would a straddle before their earnings be a good play? Maybe a strangle? I don't know if you'd want to buy at the money. You'd have to buy a decent amount of theta to avoid the IV crush too. Not really. No. There are ways to get positions there that aren't, or either positions there that benefit from IV crush. Would probably be more ideal. I didn't profit from this pump. I need a 300% return on my puts to break even. Do you see Jimmy sliding back down to 1718 next week for SLD? We could, yeah, very easily. We're kind of breaching 22 right now. 22 is a really important level. It doesn't take a lot of like downside push to drop GME's price, but it's illiquid, right? So if they want to push the price down, they're going to need to turn to the lending pool, and they're going to need to spike the borrow rate. And that's why I'm not really going into GameStop right now and buying calls, because I'm not seeing that borrow rate go up. I know it's illiquid, which is one part of like what makes like a good OPEX, right? But we're still missing that. We're still missing that increase in the borrow rate. And if they're not actively shorting, especially like before, you know, what would be a liquidity realization event, that's not a great sign. So I'd still want to see the borrow rate increase as a point of confirmation. How could $12 CSP not be profitable for the seller? I'm really not sure. Big risk off into the weekend could be a big risk off over the weekend. He is just saying he could have made more money with shares. Well, yeah, I mean, that's why generally when Upstart's at its lows, I enter like synthetic long position, like the synthetic long position for up positions for Upstart that I posted at the beginning of May when it started to fall to that like $13, $12 level, right? Those positions are much better because you stay exposed to an upside move, right? And then if the price falls, you buy shares. I mean, you're sacrificing your credit to get more upside exposure that, you know, a CSP doesn't really give you. Like a CSP is, you know, a bullish position, but it doesn't profit, you know, immensely. Like its profit is very capped, right? But by taking that credit and using it to leverage calls, I mean, on Upstart at the time, you know, put skew was kind of insane. You could easily get, you know, like very safely 3 to 10 contracts for every sold put, right? And not short dated ones either, you know. So if the stock just traded flat, you could just close the calls and, you know, pull back some of your credit. Yeah, win's a win, man. Don't stress it. There's always another opportunity, right? I mean, Upstart ran really hard, IV spiked. You can sell bear call spreads. You can buy at the money or in the money puts and capture, you know, downside as liquidity crunches again. You know, just don't try to think of everything so linearly. Like don't just look at your ups and downs. Just look for where you can make money. And it's good if you're new to focus on like 1 or 2 stocks. And that's why, you know, GameStop's still not bad, right? Because people understand it very well. Its movements are never really a surprise. You know, it has ETF FTD periods that can see slight upswings. We saw a slight upswing. It has, you know, periods where, you know, liquidity is stable and, you know, it moves down. And you have occasionally events where liquidity is realized in mass. And when those happen, you know, there's a lot of profit to be made. But the opportunities on GME are not just limited to buying calls thinking it's going to run, right? I mean, if you understand when liquidity's tight, it's going to trade, you know, relatively flat in a lower range. You can short strangle it and profit off of the theta. You can sell CSPs to capture, you know, shares at very cheap prices. You know, you can roll down and roll out covered calls and continue to profit off theta as time goes on. You know, you can set up synthetic longs right before the periods where you think, you know, liquidity could be realized, and then pull those back without very much actual risk on the table. So there's always a way to make money off everything, right? You just got to find it. Yes, and SPX moving inversely. Why would that happen? Usually that only happens very briefly and on things like stop loss hunts, or you have delayed data. How do they de-risk over the weekend? Markets are closed, right? They just dump futures Monday morning. Hard. The pre-market Monday, they just dump everything they want to dump. Also, block trades in dark pools. There've been SLDs where we have not dropped until pre-market Monday. This wouldn't be the only one. It's definitely happened before. It's shitty, but it's happened before. Generally speaking, some of it's realized Friday and then more Monday. I need to look at positions though. I gotta stop babbling. They're 41.75, picking up still more and more. Not quite on par with 4,200, but getting close. It's only about 8. Oh, that's a little more even. Now it's okay. So 41.75. Now only 100 million off from 4,200. 4,200 just sold off pretty hard. Big chunk of call interest at 4,200 just closed. That's interesting. Girk, for my birthday, make bid downs, brother. Thank you. I hope so, Alan. This has been a bitch of a week. I've been busy for the last couple of days. How are we looking for OPEX? Thanks, big man. GME's a liquid, but the bar rate's down, so uncertain. And I don't particularly like uncertain OPEXs. I'll say this. I think if GME does run on this OPEX, it won't be like Monday, Tuesday. So I'm not worried about not buying calls today. This isn't really there's not that much shorting going on GME. Like I said, the bar rate's flat. I should have YOLO'd into Palantir. I mean, I did a write-up on it. It was very good at the time. I wouldn't buy it now. It's overpriced right now. Also, don't forget, they'll probably dilute again. They love to dilute. OPV is flat. Yeah, if you zoom out to the weekly. Jimmy needs a bull market to do OPEX and also regards buying the stock more. I mean, I don't think it really needs a bull market to do OPEX, right? Like it did some OPEXs in 2022 on the back of, you know, relief rallies, right? So it needs bullishness in the market during the time period in a bear market. And then I think in a bull market, it just needs volatility. Happy birthday to that guy. It's mine also. Happy birthday, all of you guys. Matching gifts, please. Sure. What do you want? Jimmy just gonna keep going down. I have a $20 put for June 2nd that I'm happy to see profits on. Looking to take that and put it into OPEX call play, but I'm not sure whether to sell put and buy call. And do you want to buy more GameStop? If you want to buy more GameStop, then selling a put and buying a call is a very easy decision. Selling puts on shit you don't want to buy is usually a bad idea. SCX 4100 end of day. We play Bear Song on loop. That'd be pretty fucking cool, actually. Think they don't go back for the 4200s? Well, it's less likely now. Oh, is this that call I have? Yeah, this is gonna get closed. I never wrote a Dorito of Doom, DD. The Dorito of Doom is stupid. It's just a line showing GME going down. If we close at 4150, it will be my birthday also. Like that time that you got assigned on a ton of Amazon. Please don't remind me about that. I did make money. I did make money, but that was a pain in the ass. I missed a lot of opportunities bag holding Amazon for weeks. I sold BTU CSP yesterday. The OI on the strike was only 404. Is that a good thing for me? Low interest? It can be. It can be advantageous to sell options at more illiquid strikes. Because you could get a better premium, right? Not always though. Sometimes it's just really hard to get a fill when you want it and you miss the opportunity. I had 21 and 22 CCs for today. I never spazzed and bought back. Thanks to your calm and collected discourse. Thanks again for the knowledge. You got it, Grackle. Congrats. Yeah, I mean, I still have June 16, $20 out on GME. It's the only in the money one I still have, but I have a few of them. It's like a couple thousand shares. I don't think they're gonna get assigned. Is the Dorito of Doom basically corresponding to JFresh's DD of the draining interest in dwindling? What is dwaning? GME, I mean, yeah. Hey, Greg, just checking to see how the salt mining goes after all the crying that SPX filled the 4206 gap. Still bullshit, but it'll probably be better. I thought the River Runs dry DD was the follow-up to the Dorito of Doom, meaning chips make your mouth dry. Yep. You're a stock god. You nailed the 2180 range, GME range. Meet me in the back of the Wendy's dumpster for your prize. I was gonna get assigned on some SQQQ shares today. Would it be worth it to buy the CSP back, buy the 100 shares, then sell a CC if my goal was wheeling? I'm gonna say this right now. Everyone falls into this trap. Don't sell theta on fucking leveraged ETFs unless you really understand what you're doing. It's shitty, and the returns over like there's a few studies on it, but the returns over like a year are usually net negative. They appear very appealing because of their constantly high IV and relatively cheap price, but they're not. And CSPs on it are terrible unless you've perfectly timed the range. Because on like a market rally like this, you could just end up buried, and then the market could rally for months, and you're just stuck with a fat bag. Kind of like forbidden fruit. Well, I mean, it's a depreciating asset, right? So it's you don't ever want to own it. Really? I mean, like the periods you own it, you want to be the periods you need to own it, and that's it. Is there liquidity realization in NVIS? I don't know. I don't follow it. I'm not gonna like do all the work it takes to get like to a liquidity analysis on it because I don't give a shit about it. I find it very interesting that the language and questions overall on here are becoming more and more related to selling spreads and CCs. Over time, the pickle jar is slowly getting smarter because of you. Well, I mean, the market teaches some harsh fucking lessons. Don't worry, people are still YOLOing zero DTEs. Nothing's really changed. People still put 90% of their money into one position in their port. And they're like, well, I want 5 puts on SPX. But really, their port size is, you know, barely sustains 1. But it is moderately better. I mean, I'm under the assumption that most people in here are trading with less than $10,000 of free capital, which means that even in a riskier like attempt to grow a port faster, your position size should be capped at $1,000 with like 2 to 3% max risk, right? Full port. I'm making money and learning tons. I'm constantly trying new strategies with my port and having fun even if I get assigned with my cover calls. Thanks for teaching me about stops and holding our hands as the pickle jar approaches Zen. Lots of love. Thank you so much, Arugas. Congrats, man. My lesson learned in taking time to get minimum port size must be 25K. I mean, you don't have to have a $25,000 port. It does make things a lot easier. You should do a poll on the port size of pickle jar. I don't think my assumptions are wrong. Could you please discuss selling the bear spreads on NVIDIA? How should one plan to open bear call spreads, hedge them, and close them? It would be extremely helpful to a lot of us. Thank you. Yeah, I can go over it. Give me a minute. Let me at least catch up on chat. I'll have you know that all of my trades max risk is 100%. So you're saying I need to deposit 90% more cash so I'm not 100% leveraged? No. Stop treating the market like a scratch-off ticket. What does 2 to 3% max risk actually mean? Well, $30, 2 to 20 to $30? Nobody will lie about their port, right? Yeah, no one would ever do that. I lost 40K trying to get to it. I mean, there's no advantage to it, but yeah, people probably would. I lost 40K trying to get to a 5K port. I feel like asking port size is like asking a fisherman his catch size. Yeah, which is ridiculous, right? Because there's no advantage in lying. Like, there's nothing to be gained from that, right? If you sell CCs at the bottom, you can get more than 100% max risk. Rookies. Adding another message to the queue to PiFi can't catch up and give away the NVIDIA bear call spread secrets. There's not a lot of secrets to bear call spreads. They're pretty simple. Like verticals in general are fairly easy. It can get complex when hedging them, and maybe I can give an example of that that's helpful to people. No more than $20 to $30 loss on any individual position. Well, it's a $1,000 position, right? So if you have 10 open positions, each one has 2 to 3% risk. I know, it sounds crazy. That means if your entry's wrong, you cut it, right? If you don't immediately go up, it's cut. I'm not kidding. That's like standardized risk for trading. 2 to 3% max risk just seems like a stop loss will be hit immediately. It's for stocks, not options. Options, you have to widen it. You have to take more risk. But that also means that you can burn through your account a lot faster. Can you go into what you mean by cutting your loss? Closing the position immediately when it hits your risk level. I have new rules now. Thank you. Yeah, options you generally have to use a multiplier of risk, right? Like on $1,000 position, you're gonna have to take like 20 to 30% because it's unsustainable. But the base case is never an options port, right? Most of you probably shouldn't be trading options at all, based on the fact that nobody wants to read the tomb of knowledge that is options as a strategic investment tome, and would rather use it as a book stop, paperweight, bludgeoning device. I mean, worst case scenario, and you blow up your port, you can always use your options as a strategic investment to bludgeon an innocent civilian and take their money. No, don't do that. That's a terrible idea. And illegal, most places. Home security, yeah. I carved a bedroom out of mine. Nice. There's a lot of times when you speak, it feels like you're pointing at me. Good, right? At least I know what's going on here. Can't you use position sizing instead of stop losses? You're using both, but yes. So in that instance, Jay, you know, if you want to use position sizing instead, you know, and you have a $10,000 account, and you know your max risk positionally is like 20 to 30% for an options position. That means that you can't take an options position that's worth more than $200 to $300. Or presents $200 to $300 max risk in the event of like spread selling or something like that. VIX mooning? No, it's not. Is this not refreshing or something? You fibbed. You fibbed to me. Can I just hold the position until it's completely underwater? That's what you usually do, don't you? Yes, by Lawrence McMillan. Although, don't listen to anything else he talks about. His options book is good, but his analysis is like watching Dow draw his own charts. I missed JPOW in the morning. Did he say anything bearish, or is this drop all about the debt ceiling? He didn't really say anything. I think this drop is, I mean, maybe partially the walkout on the debt ceiling, although I doubt it. It's probably more just the fact that the pumpies are done. I'm not doing an audiobook of options as a strategic investment. I feel like there would be copyright hurdles. That's not my IP. I used the book as a boat to cross the Atlantic. The Coast Guard was very confused. Delayed data? Oh, okay. That makes sense. But aren't those cheap options degen plays already? How do you safely be a degen? I mean, that's about as safe as you're going to get with being a degen. Although taking better positions, not shitty $200 positions, and having a max risk is arguably better than taking shitty positions that are cheap and using, you know, position size to appropriately choose your risk level for you. I mean, I guess if math is hard, then you could use position size, but otherwise, you know, generally speaking, a $1,000 options position is going to have more theta and be at a better strike than a $200 options position. Not always, but most of the time. Ask the publisher, say you have 20k subs, that will buy it immediately. Start a music stream, lo-fi beats to get liquidated too. I'm out of all my options positions and bought QQQ. Is that the play now? Also, can you read the book to us? No, I have bad teeth and can't read. What the fuck does that even mean? What do your teeth have to do with you reading? Have you even opened the Amazon book? The Amazon box the book came in? That was 12 months ago. Maybe more movement later, yeah. Are we going back to 4,200 for the calls? They're not all gone. Puts got a little less confident on the bounce. But in the money calls are still selling off a bit. It doesn't really look like anyone's doing much of anything right now. That's on Snap for May OPEX. I want to sell more CCs on a run. Hmm. Hasn't it kind of already run a bit? I mean, maybe. I've never heard that saying. I thought you used to be poor. Yeah, but we have free dental care in New York. What if I open a position and then buy another one whenever it hits negative 20% until I realize it's now 80% of my port? Don't do that. Can you educate us on the NVIDIA bear call spreads now? Thank you. Okay, I mean, well, first you need to pick strikes. You know, whatever you're going to sell. Like earlier this week, you know, 300 obviously looked like 300, 305 looked very promising, right? So let's use these two strikes as an example. You know, you sell this, so you're selling a $300 call and you're buying a 305. And this is a bear call spread. So the profitability in this position is that the stock trades under or just at like $300, right? So you don't want your sold strike to go in the money. And then the risk protection here is that if the price goes up, your maximum risk is the spread here, right? Which is $500. That's $5 times 100. To hedge these, there's a few options. One, you can take your now you open this position for a net credit. So if a large upside move is imminent, or already happening, you can buy an additional call at your bought to open strike, or after it if need be. Like say Nvidia hit 309 and it's still ramping, right? You can buy like a 310 or a 312 or 312.50, I guess it is. And you can capture any additional upside, and then any profitability here, you'll be able to narrow that spread by however much you make off of the additional call, right? So if this call makes $5, its premium increases by $5, then you've covered the risk from here, and then any additional increase in the premium is profit. Generally speaking, when I have bear call spreads open, I'll open as it approaches my sold strike, I'll open a call here at like 300, and this hedges this is what I did this week. When it started to approach like 297, I started buying calls at my sold strikes. And so this way, any profitability within your spread and above your spread is covered by the call. So you can sell the call, and then that eliminates the risk of any higher price. If you think the underlying is going to continue rising into the future, you can like sell a CSP here and create like a synthetic long. What else? On wider spreads, like say this is like 320 and you have a max risk of $2,000, you can collapse the spread. And this is something that came up recently with someone in the pickle jar. And to do that, what you can do is you can sell in the money spread, right? So you could sell like a 280. Let's put these on opposite sides. So buy, sell. So you could sell it like a 280, 285 position, and this will provide a net credit also. But its risk is already baked in because it's in the money, right? So you can sell this position and then open a $300 call, right? And then any upside move that is captured, you can sell this, right? And then you've effectively collapsed the risk on the entire position to 500, which is the max risk here. Because now, at the end of the day, these strikes are the same, right? This works better when early assignment isn't on the table. So this is always better on like SPX or XSP, like European style options. This option is far better. But yeah, you can collapse the spread, and then your profitability becomes whatever the 320 call can gain in premium value. So if this runs to, like let's say this runs to 335, and your profitability on your 320 strike is 1,500, minus your max risk, which is now 500, leaves you $1,000 profit on what was initially a bearish position, right? How dare you kiss and tell? You love me. Don't lie. If you're buying a call at the same strike as you sold your call, are you doing that at a different expiration date? If you're buying a call at the same strike, you don't. You can, but no. No, you don't have to, because you're going to sell that extra call for a profit. So like this week I bought weeklies, right? I bought weeklies on all my NVIDIA spreads, and then I sold them at like 315. And the profit from the weeklies I bought protects the spread. But I also made money on top of it, right? Because it ran beyond my strike. Otherwise, yes, you'd just be buying it back. But if it runs beyond your strike, you have profitability. All I heard was blah, 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 buy hold DRS. So you'd want to do that while the 300C premium is 5 or less? Yeah. Is it good to play XSP in place of SPX for smaller ports? Are there disadvantages to this? I mean, it's not very liquid. Color Jemson, this might sound crazy. Are you doing a meme? Are you doing a bit right now? I don't really know how much risk management strategy is, and I think he outlined some. It's been a while since I've read the book, but I didn't pay attention to any of them. I think he has there's like a section on risk management. I mean, there are risk management strategies throughout the book. It's about options. Yeah, I'll clip it. Where do these standards come from? Most trading books will cover them. Institutions use pretty strict risk and allocation guidelines. So not too different from like what you would find at like prop traders using and stuff like that. And they're mine also. Those are but they are fairly generalized. There's different ones, there's like generally like as your portfolio grows, you have to scale and change them. But a lot of like futures traders will use like 1 to 2 profit ratios on tick size. Where find? Use Google. Look up risk management for trading. You seem to be having your mind blown by this. Why? It's not very complex. Thanks for your education, NVIDIA bear call spreads. Follow up. How does one decide to hedge if the price increment of the stock is at a snail's pace? Any rule of thumb there? I mean, are you saying that the price of the stock is going up but not very quickly? If that's the case, just roll your spread up, right? You would just roll the spread. You don't, I mean, there's no danger to the position. It's not like the price is pumping into your spread super fast. You can just move it a little bit. Like I don't, he hasn't lost his money yet. Well, it's not like I'm just carrying around a citation list to fucking inform him where it comes from. Ten 2 is a pretty common one. Like allocation to risk, usually with profits also capped at 10%. Most of them are, translated from futures traders, which, there's far more professional futures traders than equity. God dang, it's meta. Oh, what? The 0 DTE call buy for today? Asking the dumb questions for folks afraid to ask the dumb questions. I mean, it's not a dumb question, but I mean, it's just basic math, right? Like if all of your position sizes are 10% and you're taking a 2% max risk per position, how many positions before you need to hit a winner can you lose on? All right, Peters, I've arrived at my trading desk after wasting time talking to Bernanke. At this time, I'd like to divert viewers to Chapter 7 of Options as a Strategic Investment by Lawrence McMillan. Also, fuck your puts, fuck walking, fuck your calls. J-Pow has you by the balls. That he does. He somehow managed to fuck everyone today. The Bulls and the Bears. Well, the Bears did pretty good this morning. A lot? You're not far off, Pajama Samurai. The drop wasn't even a lot today. No, it wasn't, but VIX increased a bunch. And that's for puts, that's far more important, right? Also, the day is far from over. Technically, that's the point, that you can have a ton of bad plays before you become insolvent. I mean, it's partially about sustainability. It's about protecting your capital. Why stay in a loser if that's the case, right? Now that Zuck is pumping meta with AI, is Nvidia doomed? No. I mean, everyone's basically said that they're going to make a proprietary chip and not buy them from Nvidia. Like all the big players. Like Microsoft's working on proprietary chips, Google is, Meta is. So I really want to know who the fuck is buying Jensen's crap. It's not gamers, it's not crypto miners, and it's not any other mega institutions, right? Apple? Didn't Apple just come out last night and say that they're making proprietary chips and they're not using anybody else's platforms or systems? If and when they decide to work with AI. Yeah, so everyone. No one's buying Jensen's bag of shit out of his warehouse. I'm seeing the expectations for June rate hike have been lowered from 40% to 22% after Powell's speech. Are analysts regarded, or are we regarded? I mean, who are the analysts lowering it? That fucking figure from CBOE is arbitrarily based. I mean, it's not really based on anything, right? It's just an arbitrary number that they move up and down, like the fucking doomsday clock. Loosely based off of what inflation swaps, not futures. That's weird. Nope, I didn't type that. Oh. Gotcha ending. Yeah, I gotta reset the password on my Pigeon Whale account. Buying to close at GMECCs today. Fidelity gives you a warning. If exercised or assigned, your account must have sufficient assets to support the purchase or sale of the underlying security. Fidelity warns you about everything. Do you not have shares? Call them? Always easier to call them than to ask me to do technical support on your brokerage. don't fucking worry about it, Hazy. Those 4200s are getting fat. Yeah. Yeah, they are. Thank you for all the financial advice as my registered fiduciary this week. You're the explicit reason I made money from all of your advice. I'm not your registered financial advisor or fiduciary, John Wilkes. But I'm glad you've learned something here. I, for one, have a ton of faith in our banking systems. Whenever JPOW is seen, he just says they're strong and resilient. No context or questions asked. Just need to make sure we know we're safe. What's holding us up here? I thought downside had no more support. Nope, downside's had support. I said downside had support. I said like 2 hours ago that we were probably going to retest 4200 because they're not going to leave their $1 billion of calls behind. Can you reset my Robinhood password while you're in there? Can you add 10K to my account? No to both of those things. I have a feeling that if it crosses 4200, it's going to get walked up again. Probably. Has this NVIDIA sustained pump since its last earnings from February? One of your difficult, unanticipated shorts? Have there been any others that might have concerned you in the past? Oh, I mean, I was short like SPY and SPX in 2020, and that was kind of a long fought battle. I had less money back then, so it was harder, but no, shorting things can be difficult anyway. Stocks do like to go up. Obviously when I started shorting NVIDIA, we didn't nobody expected it to become like the AI baby of the market, right? I was actually profitable on my short going into their earnings, and probably should have closed it, but I remained greedy, and barely hedged my position into their earnings. But I've managed to turn it around a bit. I've made the position more sustainable over time, and I've been able to hedge most of the upside, so that's helped. I still want to stay in the position. I still think NVIDIA is extremely overvalued. I think the market will realize that at some point. Close at 4200. I don't know. We haven't tested 4200 yet, and there's a lot of calls there. All right, it could just be that they're keeping the calls there while they sell off futures, and then they'll close them. NVIDIA and Google lagging. They're leaving the $1 billion behind, just like Rose left Jack behind. Both could fit on the door. I don't want to sell data to people. If I did that, it'd be useless data. Because that's the only fucking way I'd sell it. After being learning trading here, I found that the increase of VIX is sometimes even more important than the price change. Most dead puts went pretty much alive during that March drop. Yep. Yeah. We've had like two downtrending days in the last 3 months. We've had more than that. A lot more than that. You're being a lot more than that. Is XR2 being short 400% relevant for GME OPEX? No. Some asshole's got a goddamn fire hose of money flowing into 4,200. Yeah, but we're not going up. So that's a good sign, right? SPX 10-point range bound for the rest of the day? No, I mean, it's the middle of the day, so I would expect volume and volatility to be low, especially on Friday. Are you interested in selling feet pics to people? Not particularly. Why would you selling the data make it useless? Because if it was so worthless that I would be willing to sell it, well, let me put this a different way. If the data provided so little value that I would be willing to sell it, then the data itself is valueless. Like it has no bearing on the market, right? You don't sell things that make money. You don't tell anybody about any data that makes money. There's no altruism in finance. So if I have data that makes money, it's profitable data, and the information it provides is valuable, how would selling it be more valuable than that? So whenever you approach any paid data, remember that is always true. If someone is selling you data, it's worthless. Because otherwise they would be able to make more money on it. They would make far more money on it than you could ever provide them with a subscription. If you had a market strategy that provided 70 to 80% successful returns, that's more money in a 2-year period than you could ever get from subscribers. And the fewer people that know about it, the better, right? Because then you could keep using that strategy, until the macro environment changed enough that it wasn't effective anymore. I pay for raw data. Everyone could pay for raw data. It's what you do with that data that matters. Also, people get really hung up on the idea that it's all about data, and it's not. Data, even when carefully massaged into something useful, still is only as valuable as the analysis of it. Yeah, it's not all about data. Sometimes it's more important just to shout it. No. Like, here's a good example of someone that's come up recently. Like, deep dive stocks, or whatever the fuck that one's called. The guy's always trying to promote himself on J-Roll or whatever with his VOX thing, right? Who's always saying that there's like 3,000 short squeezes in the market every day. Like, he's just selling licks, right? He's selling people licks, which is publicly available. It's a free fucking thing on TradingView. And knowing the liquidity of an underlying stock is really not that valuable. And basically what is a moving average of like gamma neutral. Some of the other like dealer positioning data might be valuable, but it can be found elsewhere for free. I mean, most data services and providers are just like, it's just like they're packaging free data for you in an easier to use UI. But at its core, it's all the same shit. And oscillators are never forward looking, right? One final question on short positions. Have you ever taken a net loss? Yeah. Due to a position moving against you. For whatever reason, no hedging, swift moves. How do you deal with it? Just take it and move on. Losses happen. There's no way to completely avoid loss. You just try to make sure that your loss isn't greater than you can manage. That's update on the free money bear call spread. Brokers won't accept an order where the credit is larger than the spread. After 4 hours, I've just gotten a fill for a max credit of 500. Well done, Bert. I try to keep my losses under 65%. Nice. No, the 4200s haven't capitulated. They just keep buying more of them. Any interesting place for CSP is worth looking into? Fubo and Upstart underlyings are higher than I'd like for selling CSPs. I mean, first thing you probably want to look at when approaching CSP is skew. Is it more valuable to sell puts, right? I think that's the best place to start. After that, maybe you could consider. I don't know. We're in a bear market. Selling CSPs is generally just not that great anyway. But you definitely don't want to sell CSPs on things like Fubo and Upstart right after they've just run. Like you want to find things that are at their lows to sell CSPs on. And I mean, sure, you want it to be stock that you want to own, and maybe you want to own Fubo and Upstart, and that helps. But I mean, right now they've both just come off of runs. Calls like 30-day at the money straddle is going to be favored to the call side. So CSPs aren't really advantageous on either of them right now. BTUs are getting better over this period, but they're not great yet, right? Okay, it was because you were using a limit order. A lot of the calls, like almost all the calls expired today. A huge swath of the calls that are on the chain expire today. They're gonna pump it past open to make it profitable again, or they're repositioning right now, right? The fact that we haven't moved up into those 4,200 calls tells me that there's like a lot of repositioning going on, because there's a shitload of interest at that strike, but we're staying flat, right? So they're selling, like, think of it this way. So the market maker is constantly buying to hedge the delta of those 4,200 calls coming in, and that creates your buyer. In a market where liquidity is low and devoid of buyers, this is a way to build one in, right? Because you can force the market maker to come in and provide liquidity. Why don't they just minimize their losses, close, and buy puts? I mean, by the time the amount of slippage that would occur in closing the 4,200 position just all at once would be insane. So they have to bleed it out over time. You literally couldn't. Yeah, it would go. Yeah, you would collapse the spread completely. Yeah, it would be epic. Are they repositioning to 4,300? I don't think so. Although on the intraday, 4,300 would be too hard to tell. Like it wouldn't create a lot of, like, there wouldn't be a lot of gamma at the strike, right? So it wouldn't, because it's not very near the money, and so we wouldn't really be able to see that if they were until the OI report overnight. Any end of day predictions? I mean, this looks pretty bearish. It could sell off. VIX is staying relatively flat in the higher range. We're still negative on the day. We've not breached 4,200 yet. So, it still looks a little bearish. SPX is entirely it's all its options chain, right? That's the only thing that can be traded on it. It's the underlying, it's the index itself and futures. But SPX options a great deal. I mean, Gork, my upstart 20p are up 13%, winning. Nice, man. I picked up some protective puts today too. Feuds to 41.73 would be a measured move. Yeah, I think a drop to like the 41.70 level isn't out of the question. Still hung up here for now though. I mean, compared to where VIX was almost below 16 yesterday, right? And even this morning was at like 1590, so just under 15. So the fact that VIX isn't dropping, and it's staying relatively flat, right? It's a less bullish sign than if it was just rocketing down. Check Discord DMs. Yeah, they're I mean, they're moving out of the strike slowly, right? They haven't moved. Those aren't calls. What are you showing me then? Oh, those are the put? Bought today. Okay. I mean, there's not a lot of put interest at the 4,200 strike. There's a lot of call interest. Oh, some of it just sold off right here. Why are you looking at the 4,200 put? Who the fuck is buying that? Above 4,200, sure. But there's just not a lot of puts there. I mean, they can't refill the TGA account. They're at the ceiling, right? Those were bought earlier today. Yeah, but there's not very many of them. And they've sold some of the 4,200 calls off, or puts off, rather. Some of them closed on that first drop from the second peak this morning. And a few more at the bottom of that drop. How do you think the Treasury ordeal will play out? I mean, I'm sure that they're going to use one of their many tools to, extend the deadline, or Congress is going to give them an extension, probably long before any resolution is found. But I don't know if they'll have enough time to give an extension. I mean, the Treasury should have more money, I think, based on Yellen's initial estimate than it currently does. The money coming in from tax receipts is not moving the balance higher as it should be. And if they wait too long to grant an extension, that could be problematic. Fuck, man, this is so flat. Just like, it kind of looks like we're just gonna get another breakdown and then a bounce. I think they're just bleeding off long positioning right now, but it's still too early to tell. We go to 4070, then 4300. I wouldn't be surprised if we bounce on any significant drop. I don't know if we're going to 4300. I love how the closer I get to my green screen, the more blue I turn. Huh. Okay. I'm done playing with it. Don't tell the Louvre. We're in the middle. Hold on. Don't talk to the Louvre about this. We're in the middle of negotiations. Are there any triangles to draw? No. Yeah, but I don't want to. Hmm. VIX is turning up a little bit. Ooh, more in the money calls selling, or out of the money calls selling off. 42.20, 15.10, 05, and 4200. Also 41.95 selling off a little bit right here. Not a lot. Not well. The 4200 move was a little bigger. 41.75, 41.70. Interest picking up. The 2000s are still 4200s are still closing. Here. Here, let me open it here. I remember said you had a PT for when you consider a bull market confirmed. I believe you said 4200. Am I wrong? Yeah. Although above 4,200 is dangerous. It's still not a bull market. As you mentioned, the SPX is heavily influenced by its option. Who is this guy? Why do you ask me so many questions? Do SPY options influence SPY the same way SPX options do SPX? No. SPY has an underlying, like a direct underlying that is traded. Can this drop now that they're done short squeezing Carl Icahn? Yeah, Icahn didn't get squoze on his GME shorts at $400 by a move from 18 to 23. If Monday morning SLD sell-off occurs, would it be quick to rebound? No, not necessarily. I mean, it would pick up momentum first. And then when there was put capitulation, yeah. But I don't think it'd be quick to rebound on the initial drop. Like, momentum would still have to, you know, turn around and repositioning would have to occur. You're not overloading me. Don't worry. You're just kind of asking a lot of, like... I don't know, the questions feel kind of pointless, but... at a very, like, rapid-fire rate. Can I underload you? I'd prefer if you didn't. Battery at 69%. Let's go. Yes, going for sub 4,200. Maybe. We'll see. It bounced here last time, right? So let's see if we break a new low. It's starting to fail, which is a good sign. 4,200s look like they're starting to sell off, which I'm very happy about. Both for my spreads and for my NVIDIA spreads. You can, Mr. Gold. Become a pontiff. Win Bear Song? Oh, not yet. My dream is for NVIDIA to close under 300, so I make all the money on my spreads, and I keep all the money that I made off the calls. I want that today. I feel like the market should give it to me because I've had to deal with everyone whining for 2 days. Can you do that thing with the pimento again? It'd be very small. Most of the calls expire today. So it'd be a really tiny pimento. When is the body pillow sheet of your forearm/wrists going to be released in the merch store? I promised Trash Dan I would ping him so he can pre-order. Fuck. There is no merch store. You'll know where you'll know that the market has crashed when I open the merch store, or at least society's doomed. Was the Pimento before zero DTEs existed? No, but it was right around the time of their inception. Bro, we doomed already. Open it up. July at the money SPX puts getting more expensive. Yeah. VIX is going up, so that probably helps. Those have a lot of Vega. When the words "smash that subscribe button" come unironically out of your mouth, I'm quitting the internet. Thanks, Maze. Sweet, pointless question time and rapid fire. Would a pint of whiskey be a good name for an Irish bar? It could be. I don't think. Who cares what the name of the bar they go to is? Never mind. Would you rather fight a bear or a rhino? Rhino. You can't beat a bear. They just eat you alive. Does your cat like to snuggle? I don't. Oh dear God, Pterodactyl. Maybe don't. Do you think Shakespeare was a playwright thief or actually a good writer? Could he be both? Hippo or a lion? Is running away an option? Hippos are more dangerous, technically. But they'll both kill you. And hippos aren't predatory, right? So, like, if you run away from a hippo, they might leave you the fuck alone. Like, if it's like a bull hippo and you're in its territory and you flee, you might escape. But if you run from a lion, that's just gonna make them want to kill you more. I have seen the Ace Ventura hippo scene. How fast is a hippo on land? I mean, I believe faster than a person, but for the same distance, they're definitely not as agile as a person. Pickle Jar sure does know its hippo facts. They're just trying to summon Rug Pullopotamus. How much distance does the hippo have to close? I mean, there's so many questions here. Can I just pivot and dodge the initial hippo bite and then he'll get bored? Like, there's probably more people that have evaded dying to a hippo than have died to hippos. You know, contrary to what the internet would have you believe nowadays, humans survived for tens of thousands of years alongside all of these animals, and we killed them all. We killed even more dangerous ones that now don't exist. That was before social media. True. Are you lying? It's called risk management. For the merch store, just curious, how big is a centaur? I don't know, like 15 hands? We killed the fuck out of them, yeah. You know why they don't exist? Because we killed them? Oh, yeah. Wasn't there like, I feel like in high school I remember learning, there was like a Native American tribe where they would just go and kill a bear with a fucking stick? Like, humans are pretty awesome. At like 15? It's called a wand. Yeah. Just like, you're not a man until you go kill a bear. Like, humans are fucking... We can also throw shit. You know other animals can't throw shit? Monkeys can. Yeah, but not as well as us, actually. Well, we are monkeys, but... I forget it is. It's something with their back muscles. They can't throw as effectively as we can. A crow once dropped a rock on me. Fine, apes. Dropping is not the same as throwing. Did you know that the most successful hunter by catch percentage is the dragonfly? I did not, but that's very interesting. You'd think it'd be orca. Those things are scary as fuck. Cephalopods can throw and use switches and levers. Interesting. We invented shit that throws shit way better than we ever could. Yeah. I spent 10 hours hauling mud and stucco to fix a wall myself because apparently Greek people don't know what a deadline or want money. Pro tip, don't buy property on a fucking island. Can I get a quick recap on the day? And JPal, I just got clean enough to sit Zom 130. JPal really didn't say anything besides uncertainty a bunch of times. and that the banks are resilient. Upon that statement, bank, the regional bank index for NASDAQ, dropped like a truck. Have a Friday Trader Joe's ice cream sandwich on me. Thank you so much, Draxix. I will. It's almost summertime. It's almost time for me to break out my ice cream Sammies. Some argue the Adze was the invention that put humans on top. Interesting. We also invented stocks. Get wrecked, saber-toothed tigers. I mean, there's people right now living in Australia. Humans are tough, you know? We can survive a lot of fucking shit. But not in the water. So the lesson there is stay the fuck out of the water, right? Crocodiles, hippos, and sharks will fuck you up. I survived Revlon 35 Cs. Humans are tough. I've been able to survive being down 50% on my GME position for the last 2 years. See? Super stonkers have been surviving on ramen for 2 years. Yeah. That's just sad. Summertime also the time to be a glizz gobbler. I mean, if you're gonna get in with glizzy gang, then yeah, that's the time. Stingrays, rip Steve Irwin. I know everyone loves that guy, but he had it coming, right? Like his death by Stingray was almost ironic given all the other things he could have died to. Greg, don't be sad. Think of all the fractional shares they've accumulated. But they're getting rid of those, right? Because they need to move from plan to book. The shorties are using the fractionals to steal their money. To be fair, his family said the same thing. They were like, yeah, it's cool. He knew it could happen. He most definitely played with fire 1,000 times. Yeah. Like people that were like shocked by his demise. I was really? I plan to book a trip to the Caribbean when SPX goes to 40.50. Nice. How's my NVIDIA 300-305 call credit spread looking today? Does it expire today? If it expires today, probably not great. Not great. When do we find out if Jimmy gets added to the Russell 2K? Well, let me check if it's out. Russell reconstitution. Preliminary index additions and deletions list posted at 6 p.m. U.S. Eastern Time. The 4175 puts are getting large. They are now... they're still not as large as the 4200 call position. Why is no one... What is going on here? Why is this not dying? I could just play them both at the same time, La Flama Blanca. Where do you look for the Russell info? Their website? Yeah, I agree, Lagwagon. It was more the manner of his death that I think surprised people. But people were legitimately shocked and sad. Like, the first time I ever saw Steve Irwin, I was like, this guy's gonna kill himself. And I was a young child. Is your DDS cost basis over or under $300? I never said anything about DDS. There's no secret DMTD. I picked up 4150, Hazy. I'm gunning, I have some 4175s. But I'm gunning for that 20x. Godspeed. Yeah, it doesn't look good. Fuck does this mean? 4200 to grab them again? Or maybe just random 4200 sell-off to drive further down? Please be the latter. It looks like the latter. If only Steve Irwin would have set stops. VIX one day and VIX getting toit. Moving up. Just give me 4170 and I promise not to buy 0 DTs until Monday. You didn't get any of the 41s like 75s, 4180s this morning when they were like $1? Those were fucking awesome. I'm just sad Volcker is dead. He would have had something to say about inflation now. Gone too soon. Didn't Steve make a big mistake taking the barb out too soon? Supposedly. But there's like poison and bacteria on those things, so maybe not. Give me 4100 today, and I swear I'll set a stop loss next time. I've heard that before. You don't need special options clearance. You should probably have a decent size account if you want to trade SPX effectively. I don't know exactly where that cutoff is. I mean, it depends on your risk management more than anything. You could effectively play SPX with $500 if you're very careful. Mosquitoes and other humans are the biggest killers of humans. Yeah. Dogs, too. Dogs are really high on the list. Don't give Half Square hope. Yeah, every time Half Square gets hopeful, he just buys more awful shit. It feels like SPX options would get immediately stopped out with $500. What? No, you can sell spreads with $500 in margin. You can sell like out of the money spreads. It's not quick growth, but it's growth is growth, right? If you can compound 20% a day on $5,000, you can turn it into quite a lot of money really fast. What was it? I did the math on it the other day. It's like 1.6 million in a year or something. You don't need 2K. Why do you need 2K? You need slightly more than $500. You need a really degenerate brokerage. DDS isn't well-you-knowing anything, Lawrence. I don't know what you're talking about. Why does everyone keep asking about DDS? These rumors are unsubstantiated. No, I'm not going to recommend any degenerate brokerages for anyone. I didn't DM anybody about DDS. It's a dentist. I just went to the dentist. That's all. I think IBKR requires 2K minimum to trade margin as well as the actual margin requirements. Yeah, not all brokers require that. Did you know Linux's brokerage calls him every day to let him know his position is risky? No brokerage is calling you because your paper trading account is at risk. $500 with 20% compounding gains would be over 2 million in just 40 days if you full port and never lose. There you go. So the answer is never lose and never apply any risk management strategies. It's simple, just full port and never lose. Yeah. I'm gonna start an account and do that and see how far I get. Just be right 40 times in a row. It's not impossible. But it's improbable. Isn't that the stream account? No. It's basically impossible. No, I mean you have to get lucky, right? Like you have to have a market that doesn't make like any 1 sigma moves for 40 days. Which right now is yeah, probably not going to happen. But there are macro conditions where it isn't impossible. So like we just had, kind of, yeah. Although no, you'd have to, well, okay, like we just had, but you'd have to have theta on the positions, which you can't really afford, right? You can't afford the theta, like the overnight risk. Good, Andrew Carlson. He turned $800 into $350 million in 2 weeks. What do you buy Dogecoin at 0.0001 cents? Here's my strategy: full port into brick and mortar used game companies run by man-child looking guys with rat dogs. What's a triple bottom mean for SPX? It means there's resistance at the bottom 3 times. Triple bottoms aren't really a thing. A double bottom? I didn't. If there's a 90% likelihood of an event, you have a 1.5% chance of being right 40 times in a row. Okay. It's still better than the lottery. I mean, this is eventually why, you would employ risk management. If you were right 5 times in a row, you would want to start employing risk management, right? But did puts just capitulate? A few, yeah. But so did some calls. Just more 4,200 buying. Gotta pump it back up. Perfect, F1 Dan. That's all the money you need, right? Halfway through that process, you can just crash the market yourself. Morningstar says Apple is worth 150. I'd say that's a little optimistic. I had a rare day off today. It was cool being able to watch the stream. Thanks for answering my dumb questions. Keep up the good work. Thanks, BGZ. I appreciate it, man. My record is 7 in a row. Then I lost 50% on number 8. I've had like a 20 21 like compounding win streak in a paper account, but never in real life. How much do you think it would take one person to crash the market right now? Probably a lot. I don't know. 15, 20 billion? How would you require that would require a 4200 4205 credit bear spread right now with $500 of risk. I mean, it's max risk. Every position has to be max risk when you have a $500 account, right? But I mean, you wouldn't have done that, right? You would have probably sold like earlier in the day, first of all, but back here you would have sold like a 40 20 25, right? When the 40/20s were trading at like 6 credit. And then you would have closed it here. Welcome back to Dillionaire Beef. Thanks, man.
Happy birthday, Gert. Yeah. Yeah, we might have a chance, but we ain't got rope. Give us more than a chance, cause we ain't no coke. Get the cash in advance, cause we hold it afloat. If you are what you eat, that makes gherkin the go. Hoping that you read the DD, cause when the shit squeeze, we go end up with the
20 billion to get us to 4,200 to probably to break the level we're at. I mean, like that's gonna be fucking absorbed by the market makers too, right? That's the problem with like, what if someone like those questions or like hypotheticals, or if someone dumped a shitload of money, like the market makers would just absorb it if they could. So it has to be more than they can absorb, which is a lot. Also, if you did that on like a lit exchange without like a dark pool or something, you'd get front run so fucking hard. Your slippage would be unreal. Hey Greg, thanks again for all you've done. 22 months. Been killing some entries and exits lately. VIX to 1830, maybe more. That'd be really cool if we saw VIX at like 18 or 19 today. Right now, it doesn't look like that's gonna happen. I mean, I think what we're seeing is kind of bearish, but I'd still want to see the consolidation break down more. We are seeing a bleed of the longer dated long positions, but it's very slow. Thank you, Eli. You think we'll break through 4180 on the next test? It's possible. There's still like in the money call interest at 80 and 85. Don't you only get a PDT over 3 of them? Like 3 open close? How do you guys deal with that? Like, seriously, like, how do you deal with that fucking restriction? That sounds like a nightmare. Like, why not just use a cash account? You just make sure you only run overnight spreads minimum. But you're allowed 3 a week, right? Or 3 however many trading days. No, I think IBKR got rid of the day trading with unsettled funds. I think WeBull still allows it. But will we get to 4150 is the question. We'll find out. Doesn't Webull do instant settlement if you haven't had a GFE? What if you open the spread in pre-market, close it in after hours? You can trade spreads on cash accounts. Fidelity also allows it, but that's something called a GFE. I know what a GFE is. And, yeah, but like, who cares if you get locked out from opening with? I mean, it slows down your ability to trade, but like with a cash account and no GFEs, you should be able to open a position. Oh, so you should be able to open, close, open in the same day, but you can't close again. If you close again, you'll get a GFE or a free ride violation. I had a June 1st and 16th, 4120 and 4100. How fucked am I? I mean, I have the same positions, but for the 16th. Because they look pretty fucked. I don't know. I bought some more of them because they looked so fucked. I did this fun, cool thing called failing to meet a day trade call, and Fidelity banned me for margin for 90 days. No, you can get a free ride violation on a cash account. The bulls have to defend gamma neutral. Well, they don't if they close their positions. I'm going to stand by my statement that there are no bulls. All the bulls are fake. Fake bulls with no liquidity. Bulls aren't real. Bulls seem like bears with bags. I'm here like every day. Whatever. If this is a risk off, what we see over the next week or so? A lot of downside. This is JFresh's drunken full market short squeeze. I don't know. I mean, it looks like the little like sold calls positions got squeezed out yesterday, but the big ones are fine. They haven't moved. If anything, they're going to become emboldened by the fact that the bulls aren't pushing above 4,200 again, and sell even more calls, right? Everyone's always so impressed by the bulls going up 200 basis points in a day, but when the market drops, it can go down far harder than the bulls pushed it up. These are not equivalent moves. Positive gamma environments are stable. Negative gamma environments are not. Anything else more pressing besides horrible PE ratios? I mean, that's a good reason to risk off, right? I think there's a strong case to be made that there's been risking off occurring since the banks failed. Like, it's not just the actions of yesterday and the day before that are the risk off, but the actions of the last, 2 months. I mean, we've seen progressively less and less money flowing into equities by major institutions over that time period since the beginning of the year, right? And then even less equity, like capital flowing into equities since the bank failure, despite all the liquidity given up by the Fed. And if we make if me and Doric were to come to the assumption that our data is correct and the things that we're looking at are showing us what we think they are, I mean, it would imply that major institutions have risked off before every large correction ever, or at least within recent history, the last 20 years, that they have been fully and absolutely prepared for any downside. And they are, because we are perfect and infallible. I don't know about that. And you do have the advantage in an illiquid market of being able to move the market strongly with very little capital in derivatives, right? And thus, by moving the market, create your buyers from the other market participants. I mean, sure, you can pump the like bullish narrative on CNBC or whatever, and get some boomers to pick up some of the slack, but ultimately, you can create the buyers for your position if you have the capital. So why wouldn't you hold the market in a range while you exit your positions before letting it fall? And zero DTs just help that, right? They just make it easier. Maybe they thought we were really going to crash in October, and they were like, fuck this, I'm not holding these bags. And they've been just risking off ever since. I mean, they own a lot of fucking equity, right? Their exposure after 2021 was insane. Don't forget the ability to pump by recalling shares, too. Yeah. I mean, I don't think you can so specifically define it as, it's probably not like BlackRock, Vanguard, State Street. To some extent, it may be, right? But most of their exposure is in ETFs. Like the majority of BlackRock's like equity holdings are ETFs, right? I mean, here, look. Like, hold on. Look at this, like, ridiculous shit that happened before the COVID crash, right? From its low here in October, we moved up 18% into February's SLD period, right? This is SLD right here, these few days. And then OPEX, and then we crash. The pandemic situation from December, from right here, was only getting worse, right? So we got a little bit of fear here during January OPEX, right? Then the market just I was short the market, right? The market just fucking rocketed. So I was short here, like, early December. I started building my short position here. When we first had confirmed cases of COVID in the US. The market's reaction to a pandemic spreading in the US was straight up. This is, yeah, it was the similar situation, right? Nothing was bullish about it, but the market just kept going up for no fucking reason, right? And like, you know, if you go back and you look at the liquidity data and, you know, the volatility during this period, it's pretty obvious that at least this period here was just risking off by institutions. They sold as much as they could at the top, and then they sold the rest on the way down. I mean, these look at the fucking SPX gapping up every day in this period. These are big. These were huge. Like 100% a day for 3 days in a row. From the bottom of this, we moved up 5% and we really hit it right here. 5% between in the first 2 weeks of January. We've moved up 2% in the last 2 days. Were you hedging your long? No, I was like tapped out. I just kept whatever money I got at the time, I just kept buying more puts with. Which, you know, in hindsight was fucking terrible and a huge mistake, but and it's not like just the COVID crash, right? Look at the 2018 China scare, right? We just from the time the news comes out, we just rocket up into the crash. Even fucking Volmageddon. Like, look at Volmageddon, which was an unexpected event, right? Supposedly. And then, you know, 08. And this was after the failure of like Bear Stearns, right? And then this was the failure of Solomon Brothers. This is about 14%. If you watch The Big Short, this is the part where they start buying more CDS or Lehman, yeah. I mean, the right before the earnings contractions in the dot-com bubble, you know, every pre-earnings season met with rallies, and then this is actually more. I think I still think our current, you know, situation is far more similar to the dot-com bubble than anything else, right? Because a lot of the overvaluation in the market is on, you know, future earnings, which are not going to be realized, right? Which was similar to the situation back then. But like from here, you know, we pumped from September of 01, you know, all the way into Jan of 02 before failing. And then, you know, we pumped again from Feb through late March, and then, you know, continuous decline right after. Also, you know, the older and older crashes you look at, the less informed investors are prepared, right? Because they don't have the same information that they do now. So if you go back, let's go back to like 88. There's a very very little pump before the event happens, right? Or 87 rather. And then the further you go back, the less prepared institutional investors are. Not paper trading, I mean just, you know, they didn't have as much information. You believe we're heading for an eventual deep market correction? Yeah, I think so. I mean, I don't think the current market valuation is sustainable. I don't think that any of the tech companies, which are currently the only thing that's holding any value in the market, are going to be able to sustain the margins that they, you know, have told investors that they'll be able to sustain. Yeah, but now it's been 2 years. That was last year, Hestia. The economic conditions are drastically different, right? And they started to get bullish in January. We really did have some bullish data coming through consistently at the beginning of this year. But it's all turned sour. And we were bullish as fuck at the beginning of this year. After December's lows, me and JFresh and Dork. I mean, Dork was still pretty bearish, but we were all bullish as fuck for a bounce. You know? I was very tentatively bullish. The data was way more ambiguous than it is now. That's true, yeah. And really through the beginning of February, we still had, you know, a positive lean to the way the year was going to play out. And now we're seeing, you know, that positive outcome still being priced into the market, but now the data's against it, right? Jan is when I bet JFresh and became a stunk daddy in March. You selling some BTU CSPs today? No. Am I being greedy? Probably. Why didn't you tell me JPOW was going to rug the market today? I rolled my $22 calls yesterday. I said SLD wasn't over. I mean, what else do you want me to say? I said it looked like a risk off. It still does. If this is a risk off, are there any signs that the pump to sell is done? I mean, but we don't know how much of a risk off it is, right? That's the problem. Is this it? Is this the last one? Is this the final leg before they dump everything? We have no idea. I would say every time that we get one of these, we get closer. I mean, the Fed's not going to resume QE until inflation's sub 2%, right? Till they whiff their goal. And if we haven't crashed by then, we definitely will at that point. Nobody wants to be the first person to price in the shit hitting the fan. Well, that's going to be real bad for like June inflation swap holders, right? And then worse in the September. Like I mean, they're still pricing in. He said it was down 22% today earlier, or somebody said it was down 22% today earlier, or 18% today earlier. The current speculation on what the Fed's rate increase is going to be on the next meeting. So that means that they've now again downpriced the June swap, right? So they're still expecting 3% inflation by June year over year, but the month over month is still rising. If that misses its target, then they have to price the September up. I tagged you on the Discord for the tweet. Thanks. It was Smooth Ape. The issue is the tightening credit conditions have not been fully priced into the market. Well, that's because the credit conditions aren't really tightening, right? The banks are trying to stay above water by loaning out as much money as they feasibly can at high interest rates to protect their fucking duration risk. The fear and uncertainty is starting to spread among the boomers, retirees, and near retirees. That's a start. I mean, it already is, right? Like capital flowing into money markets is way fucking higher than capital flowing into equities right now. No one wants to take on any risk with equities. But that also in turn makes equities illiquid and volatile. So we have a lot of realized volatility. This is something that should be at the forefront of a lot of options traders' minds. We have tons of, like, look how many 100 BPS moves the SPX has had since March 31st, but VIX, all-time lows, right? That paints a picture of market participant positionings, right? That tells you that, volatility is being shorted heavily. Which is, insurance. Like, shorting volatility is insurance against a black swan event, right? That's what Kenny is. He's an insurance He's an insurer of risk for everybody. And when risk happens, which is an inevitability, Citadel will take the hit. He's very good at it. Why do you think Citadel was short treasuries? Does everyone remember that? You can't play CDS. You can't buy them. You can arrange for them to be bought on your behalf, but you don't have an ISDA. But that's because he only needs to worry about being short volatility and hedging that short, right? Neither do you. You're not special. I mean, you can acquire them. I could acquire them. You didn't need to time him out, Fluffy. Was it because he said it wasn't special? I'm calling Ben Rickert. If you have enough money, you can get exposure to CDS. There's ETFs too, right? A couple of them. So even without, you know, without an ISDA, you can get you can't directly play them though. But you can get exposure to them. Ken hedges his MM branch with his hedge fund branch. Sure, why not? That's like primes passing off fucking liquid, like, risk to family offices. It's all about diffusing the risk, right? At the end of the day, he still wins. We're actually getting a pretty well-formed bear pennant here on ES. It's a little low. Boop. This will probably break up, right? Well, that's how CTAs make money, right? Right, Bean? Like, futures traders, they make money on that. Like, everyone's taking the short position. So, yeah, you go long. It's just like a systemic contrarian trade. You're gonna be terrified the SPX is gonna gap up 100% by Monday open. Why? We're about to gap up to 4,300. Then why are the bulls selling their calls? Are you just saying that because you didn't sell yours? Lugs, thank you so much. Guys, give Lugs a shout out for hooking you up with Cornishon. Welcome aboard. I want a song. Which song do you want? Go on, you get one. You don't know? I'm having a bad day. I'm sorry to hear that, Lugs. Let me see. I'm gonna play the 510 song. Fuck yes.
We don't give a shit about theta, it's pure science, just look at the data. Less than $30 for a 510 call, just do the fucking math, it'll make your wife's bank account crawl. And once you get that itch, open up the calculator, realize you're gonna be rich. Might just be my fiscal immaturity, the definition of financial irresponsibility. Just when you least expect it, surprise 100x gain just on your initial investment. What you gonna do, take your profits and walk? I said fuck no man, I'm gonna use that leverage to cock it, lock it, double down and profit, show my gains to Gert like a first place ribbon on a science fair project that he didn't help me with, cause technically can't. Kung Fu, Rumple, Dr. Something Dinosaur, Delta Strike, Eric D, Pickle Morty's hugging me, Dungston, Parks Car, Salmonella, Smock Spots, Cat Doc, Army Vent, Jay Willen on Trash Stands, Nutsack, Windmill, Corn Trader, Moon.
Fuck yeah, not sure.
Long Boy, Optimist,
Back in the
Shell,
golden
Lapis,
days.
Snow Case Saber, YG Bourbon, and that bear named Dave.
This market crashes soon. The golden days will be now.
Orda Concrete, Dave of the Pigeon Whales Diet, Birdman, Buff Dan, JG, Cybernetic Construct, Hands on the Dancing Queen, Kermit, Desperate Danny, MMO, and Merc the Jerk, Dark
Did you say calls were selling off
Pablo, Emphasis,
earlier?
Delta Strike, Woe Heavy, Donkey Dick, Tri-Feed, Dead White.
Now they're picking up again. Some 4220s and 4215s just sold off. You know, call positioning is dynamic. Just FYI. Not only can they be sold, they can then be bought again. So it's like the selling of them is not permanent. I feel like you're assigning a permanency to the selling of these options. Like one tick, 1,000 calls might fall off the 4,200 strike, right? And then the next tick they're bought again. They don't get PDT, believe it or not. Is what a bear call spread? I'm calling the SEC. Since the DAX made an all-time high, won't the narrative now be the same for SPX DAO? No, because no one gives a shit about Europe. I mean, no offense, but it's true. After listening to you talk about risk management all day, I've decided to try it, and I just sold some 419 calls. Naked? I remember dropping 5K into 510s and held that until expiry like a true G-Gen. Okay, so another big block of 4200s just shifted off there. How high was VIX during the COVID crash? Fuck. It hit like... if I remember correctly, it hit like 83 or 84. Something like that at the top. Might have been a little higher. It was like mid-80s. No, it was higher. It was higher than 80. Like the peak of it was higher than 80. I mean, you can't calculate put value purely based on the VIX. That only affects the value of the implied volatility on the option. Or are you asking how they calculate VIX based off of... They use a spread of SPX, like the spread of SPX put options, 23 to 30 days to expiration. I mean, VIX IV was so high that it would have been pretty hard to make a lot of money on puts. But yeah, shorting volatility when it's at all-time highs is generally not bad. Like, bear spreads were really good. VIX at 89.53 after 08 stuff. I mean, like, it hit higher than that. VIX was in, like, the fucking 90s back in, like, end of 08. I almost hit 100, I think, at one point. That sucks, Leela. 4150 on or off today's table. 3 o'clock already? Probably off the table. It's not impossible, but I don't really see any slowdown in the call buying. Like, blocks of the 4200 sell off and then new blocks come in. We still have a lot of like downside support at 4180, 41 through 4180 through 4190 on the call side. So they're still in the money calls. And the in the money calls are still holding things up. Now, if those sell off, sure. Maybe it could dump into close. I don't know if it hit 41.50 though. That's a big drop. It's what, $38? Hmm. Jorg, the butthole's getting really tight. I don't know if there's enough time left. Fact remains that nobody's in a big hurry to sell off their shit. Yeah. Do you expect a T+2 pump on Nvidia next Tuesday? That'll depend on what the price drops to between now and then. I mean, not really. There weren't like a shitload of strikes that went in the money. The 300 did. So there could be some carryover from that. The 320's back out of the money, 315's back out of the money. So it's really just like the 300, 305, 310s. There's probably not that much exposure from that. And if it drops more today, like if it drops below 310, there's really not much exposure at all, right? DDS, $300 end of day? No. Maybe like 255. SLD's not over, and OPEC settlement hasn't even occurred. That's for day trading, Smooth Ape. It's not for like buy and hold positions that you're DCAing. I mean, you should scale into positions, and that's up to you, right? You can limit your risk by buying more. Like if you're gonna scale into a position, which I wouldn't really use dollar cost averaging, but to describe that. But yeah, I mean, if you're gonna scale into a position as you enter it, then you would simply wait till you hit risk and then buy in, right? You would keep adding to the. So if you bought like $100 worth of shares, then you would add in another 100 when you hit your 2 to 3% risk, right? Until the position started to move favorably. But yeah, that's how you would scale in, is you would scale in at risk. Most of them are for day trading, yeah. Those aren't for like long-term positions. That's, I mean, then you're investing on value, which may not be realized by the market for like months on end. Maybe years, right? What is Citadel or Susquehanna going to release their god algos on Nvidia? My puts are bleeding out, thus my bearishness has turned to anger and resentment towards Nvidia. I don't know. Maybe after earnings. We'll see what happens. Earnings are next week. End of day, face melting pump again today. I mean, there's a shitload of calls at 4,200 still. I don't know if it'd be face melting, but it could be a pump. One or the other side will capitulate. Yeah, that earnings call was just ridiculous. It was. I know. But it was the promise of future potential, right? Partially. I mean, the market is forward-looking. Now, this earnings becomes the question, are they going to meet that promise in any, material way? And I think the answer is no. I'm still going to hedge that fucking earnings, though, because this market's ridiculous. I mean, there could still be with hedge it. That's the answer. Earnings are binary. They're not predictable. They could, yeah. If history has shown us anything, the market will be at 3,900 because the puts at my puts at that strike expired today. Bots, and cats and bots. Thanks, Garev. Why is there no SLD sell-off? Would that mean SLD isn't over? Nvidia is going to 325 and falling from there on. Or it just falls today and never goes to 325. It's possible. SLD not being over doesn't really matter. When options expire today at end of day, buy more theta. I mean, the fact that you wouldn't have enough theta to cover the entire period in the first place is already kind of questionable. I bought theta at the wrong time. Then there was a time in that period where you should have changed the amount of theta you had. There's... Oh. True, when my CCs were up 85%. Yeah, why didn't you just close them? Why are you holding for 100%? So you added risk to the position by waiting in order to grab 15%? You gave up 85? That's like recency bias though. I just closed my sold call on Amazon. Thanks for sharing the free put idea. Just one contract, but still free is free. Nice. Yeah, nothing better than having the market maker buy your puts for you. Yeah, I understand. No one's immune to it, man. I'm not trying to say I'm better. I'm probably one of the greediest people in here. Theta males. Thanks, Andrew Tate. Looking ahead to next week, other than PCE Friday, is there any other data that could move us up or down significantly? Well, we still have, you know, the realization of like OPEC settlement to go through over the next 2 days. I'm sure there'll be some volatility, but yeah, next week we get the dot plot from the Fed. We have PMI data. I believe we have unemployment data or employment data, right? Is labor data next week? No, next week's PCE. Sorry. PCE. We have PCE next Friday. We also have corporate profits. We have our second GDP statement. We have a bunch of Fed speakers. We have mortgage data. We have PMI flash report on Tuesday. Monday is pretty dead. Saturday we have the debt conference, the debt ceiling news conference. $85% plus 15% is 100%. He's good. He got the full amount in absolute values. Did the conference got canceled? I mean, I know what's his face like walked out today. He was like, I can't negotiate with these goddamn Democrats. And then, you know, they're going to be like, we can't negotiate with these goddamn Republicans. And everyone remains divided and split and not realizing that they're all paid by the same people. No problem, Obama. Thank you. Why did... Never mind. Ooh, big fucking fat chunk of 4,200 just closed. Okay, that was like a billion. That was a big position that closed. And now some of it's back. Still down about 500 million though. A lot of gamma closing at that strike. Why the fuck is that? Longer? Maybe it's longer dated. Ooh. Interesting. Longer dated 4,200 selling off. I like that. About 700 contracts there. Yeah, keep dumping those. Lol, and now some of it's back. Debt ceiling impasse bullish? No. I fucking hate our country's government. Did you sell Palantir CCs or BTU CSPs? I haven't sold BTU CSPs. I did sell Palantir covered calls. But I wasn't greedy with them. I just sold at like 10. 10 for June 16th. Dude, you can't say that. What about jail? What do you mean, what about jail? You can't go to jail for saying that. Is there a government in this world that anyone likes? There's no. It took me a while to write my message, and I'm too lazy to rewrite it. Learn to copy and paste? I'm not gonna go dig up your fucking mess. It's not immediately available, so I'm not gonna go try to find it. Which option strategies do you recommend us to learn? All of them. I'm debating holding 531, 4130 puts over the weekend. Average down, but still 35% red. I'd probably get out of them today if they get to cost basis. Any thoughts on holding through the weekend? I mean, you're going to lose some theta on the position. I don't know what your max risk is, but if it's close, you'll probably hit it. I mean, you have a little bit of theta, but you are gonna lose some premium value over the weekend. I keep waffling between selling in the money GME for 616 or selling out of the money for 526. Selling, so you want to sell covered calls into OPEX? All right. OPEX is still funny. Everyone's like, okay, it's gonna be an OPEX, so I'll sell calls, or it's gonna be an OPEX, so I'll buy calls, right? And then no matter what outcome, half the people are sad. It's perfectly balanced. When the real answer is don't sell calls into OPEX, and don't take long positions on GME unless you have confirmation of a move, or IV is ridiculously low and you're buying leaps. No, OPEX is T+2. The period in which GME runs is during OPEX's settlement, not the actual expiration of the options. All these calls fall off today, right? A lot of them. So does the MMD hedge those next week? So lots of selling. SPY is consolidating right now just above... Oh, fuck you. If you ever mention a fib retracement to me again, you've already pushed the envelope enough. If you start talking to me about Fibonacci's, you can actually go fuck yourself. Ugh. Why don't you just cast some bones on the ground and see where they land and make your decisions off that? Oasis? SLD is the new OPEX and SPX is the new SPY. Everyone just trying to get rich on lottery tickets instead of playing what the market gives them. Show us on the doll where Fibonacci hurt you. People who use Fibonacci in the markets are already morons. Using a natural ratio to predict the outcomes of a chaotic system is arguably one of the dumbest fucking things that I can think of. The only thing worse might be Composite Man. If one golden fib wave collides with 3 Velo weekly triggers while Keltner wags off into a cloud, do puts cost same like shares? Comedian is podcasting with me, LOL, yesterday. We said gourmet ice cream shops that sell olive oil ice cream can sit on it. Are you flipping me off? Rude. Throwing bones on the ground? Stop giving away my trading strategy. Oh yeah, because every human... What is Fibonacci, Mr. Gold? Define it. Define the golden ratio. Trades uses Fib. He's a millionaire. Yeah, because he sold AMC at the top and then jerked off his viewers for another $1 million. Warren Buffett's a billionaire, and he's probably never used a fib resistance in his life. I didn't ask you, dork. That's not the point of this exercise. The point of this exercise is just shut Mr. Gold up. Yeah, but Fibonacci's not data. It's just what people use to draw support and resistance badly because it's easier than actually learning. Have you ever seen a chick rip her head out of the water and the thing her hair does? Fibs are like that. Mr. Gold is like if Walken and Stefan had a child. Win Charm the next 30 minutes. Charm just going to be offset by them closing in the money 4180, 4185, and 4190 calls by buying 4200s at a ridiculous pace. It's boring with no antagonist. Ooh. Okay. That was interesting. 4200 gamma just dropped bigly. Also 4195 and 90 moved down as well. 205, 210, 215 all a little bit. And 4175 and 70 picked up a shitload of puts. Maybe they don't do the pumpies. How much trouble are my 4120 puts in for next Wednesday's expiry? Yeah, they could either be in a lot of trouble or not a lot. I mean, 4120 is below gamma neutral, so tough position to be in. It's not out of range, but still tough. You know what's infuriating about it, Mr. Gold, is we already give you better data than fibs. You have like you have the gamma levels from this morning, you have gamma neutral, you have gamma max, you have delta neutral, and you're like, I'm gonna use this magical ratio to determine where stocks are gonna trade. I was able to close my SPX puts profitably and roll all my other garbage out. Huzzah! I live to die next week. Fuck yeah, Jay Fresh. I just checked my 401k, which is some basic target date fund, and it's only down 5% in this market. Not bad at all. How is ever can you not buy Jamie Dimon's hedge equity fund in 401ks? How is that not just the best thing in the world during a bear market? Hey, Greg, where's Kendra? My workdays have been shockingly PG for a while. Kendra's here, lurking, hiding in the shadows. He likes to jump out and surprise people. I know you're here, Kendra. I can see you. Why would I open an ETF that holds Revlon, Fubo, GME, and Revlon's not even a stock anymore? It's a private company. What do you see happening this OPEX on GME? It could run. Probably won't, but it could. I'll summon Kendra for you. Fast 5 was not a good movie. Good luck, everyone. Oh, shit. Do you want to create an indicator with me called Pascal triangles? Yes. To sell, right? You picking up some 4100s expiring Monday? They'll be in the money by open. No. I do have 4100s, but I'm not going to buy any that expire on Monday. Not to carry over the weekend. They'll have to go like $4 in the money to print. Along with access to a special trader Discord that we never check on or update. Okay. I wonder if like if someone else, like if I make it under a pseudonym on Twitter, if J-Roll will reach out to me and be like, "Hey man, I'd really like to share this data with my community." People using Fibonacci are saying like people smashing the Dunning-Kruger and or highly opinionated. Yeah. Fibonacci's particularly good at building up a lot of confirmation bias. No, I have not defeated the cat allergies. They persist. Real talk, I'd love to have an actual ETF dashboard, but I don't want to spend the money to build it. Yeah, but I'd just be building it for you. You're arguably one of the only people in the world that would use it. What dates are you straddling? I'll probably buy end of quarter options tonight. 4,200 wasn't as bad a straddle as I thought it was going to be today, though. I really thought I was going to get fucked on the call side overnight. I love you, and you can't do anything about that. I could try. How does that make you feel? Awful. Also, I don't know if gold is real or not. Also, I haven't made a trade in weeks. Also, I have to listen to you make any judgments. Witchcraft and data are real. Hmm. Thoughts on TGA going to 0 and beginning the delisting process on Monday. I don't know. They gotta pay paychecks today, right? I don't know how government people get paid. Do they get paid on the 12th or today? Are they in a bi-weekly pay schedule? Is it different in every part of the government? Do they only have to pay some paychecks this week? SPY making higher highs and lower lows. How does that make you feel? Like nothing. I actually don't care. It could apply meaningfully to market probabilities. But I'm sure we could develop something that doesn't apply meaningfully. Like, hmm. Monthly pay and usually last day of the month? What about military? When do people in the military get paid? Do we pay them? They get paid, right? Or Pascal's Wager, which is basically buy calls before every earnings. Bet there is a God and choose to follow him to go to heaven. I mean, there's like funds that just strangle earnings. It pays the bills. What's a marine cost? $5. As a spouse of a reservist, no, they do not. You can't strangle God, Kirk. Is it legal to pay disabled people less than in most states? Wait, what? It's legal? What is? Oh, you're talking to Dork. What's Dork talking about? Marines? Ah, ha, ha! Roll 616, 285, NVIDIA puts, or take my chances. Up to you? Are you going to hedge them for earnings? Are you hedged in any way? Are you offsetting their theta decay? Are you just holding them and hoping? It's called Patriot Time. She's been working for 2 hours now, unpaid. That fucking sucks. That's like community service. If you get caught doing something illegal in the future, can you claim Patriot Time as community service already served? Wait, really? Isn't that a violation of federal labor law? No? That's fucked up. You're a wicked asshat. Stay away from my plays, half squart. You're not even a dillionaire. Sorry to hear your city is sinking under the weight of its buildings. It's not? Can that crash the market? Probably not. New York's built on bedrock. Why would it be sinking? I remember one year some Russell. Can I pull back my cover calls on Monday, or is that risky? Wait, are you saying that you're a member for... Wait, so you're waiting on the Russell decision to pull back your... It happens after hours. Can I curse in Ko-Fi's? It's not the end of the day. No, Ko-Fi will block you too, Stan Banan. Ko-Fi's got its own censor thing. I mean, I can say what you were gonna say by then going to Ko-Fi directly and reading the message unfiltered. So I guess that's a way of beating YouTube's filter. My grandfather works for HUD and has spoken about how multiple areas of New York City will be underwater in the not too distant future. Yeah, okay, I can believe that. But that's rising sea levels, right? It's not like sinking New York. It's really annoying that Jim Cramer seems to jump and bandwagon onto all the plays I've picked recently. And it's like a lot of them. There are actual studies that show New York is slowly sinking by tiny amounts. We'll just build walls, right? New York is also moving, but the amount the tectonic plate it sits on is moving. Yeah, but like, who cares? I'm gonna be dead long before any of that matters. Drowning in a flood. My grandpa works for the Sea Level Control Administration for Atlantis. He assures me all coastal cities will be fine. Trust me, bro. I'm just gonna start buying real estate 30 miles from every current coastline. One of my ancestors will be very rich. Or descendants. Bank gap down hard. Good. Fuck that piece of shit. $50 meters above sea level, a mile from the coast. I'll work with a geologist. That's the Midwest. You played yourself, but then it won't be, right? Nope, I did not say that. BOFH. I'm like 130 feet above sea level right now. Do you think you'll be able to get the liquidity that's generated from today's after hours Russell 2K inclusion available for the members call on Sunday? No, probably not. I probably need till Monday, at least. Cork just doxed his elevation. Didn't someone in here say before that SPX would close at 41.93.65 today? I don't think so. Are you the guy? Are you saying it? Gork, what do? My put is $6 in the money. On what? I'm not telling you. It's my secret stock. Okay. Well, then I'm not telling you. How long do I have to close my CCs that expire today before being exercised? 6 minutes? Not 4:15? I don't know if you're gonna be able to. It depends on your broker. I don't know if you're gonna be able to close them after hours. Why would you want to wait till 4:15? You're gonna get put on hold for 13 fucking minutes. Shout out to whoever exercised my GME 21s yesterday. Is the Lily play dead on the technical side? Yeah. It's been beyond like max risk now for like 2 days. 3 days? I'm gonna stay short though. It's not a very big position for me, so I don't really care if I lose 100% of the value. The potential reward is worth it. BTU looking like I'm gonna buy more soon. Nice. Is next week SPX 4250? I don't think so. Have the 4200s rolled off, or are they letting them expire? They're buying more of them. Not for today, though. Monday, maybe? Hold on. Some being bought for Monday. Not a lot of volume trading there. A little bit of volume on the June 16th AM. A lot of volume on the 616. Actually, that's not much. It's just a big spike. That's only like 500 contracts. That's still a decent amount, but that looked like more. Okay. Yeah, this actually isn't very much. It's just skewed because all the rest is flat. Where the fuck are they buying these? Maybe next Friday? No, that's pretty low too. Like 150 contracts. Maybe it's just the 0 DTs and they're not coming in on WeBull. That'd be weird though. Tuesday? Was like the contracts got more volume, but it's not. That's fucking strange. Hold on. Hmm. So it should fall off now though, right? Because we dropped. $4 drop. GME closing at 22. Ding ding, by the way. Thanks, Sads. I don't know, maybe they're sold, but I'm not seeing any volume on the contracts across any of this like relevant strikes. Well, SPX broke down from 4,200 today, which I think is significant. Obviously, we'll see what happens in after hours. We still have till Monday morning to see any kind of relevant sell-off. Although I do think we were seeing sell-offs throughout the majority of today. You know, these periods and these big drops that we got, these weren't all just, you know, option selling, right? There was some pretty serious futures volume on the sell-off earlier, like quite a lot. And on that last drop into the end of the day, quite a lot of volume on that candle as well. So, I think some of SLD is realized in those drops that also the drops that we saw yesterday, but I don't think enough. I mean, or at least not as much as we normally get. Yeah, that could be a property of the haircut that was received in the middle of the month. And we'll have to wait until Monday to see what effect occurs over the weekend, if any. A lot of calls expiring, obviously, today. That's going to put the market maker in a little bit more bearish of a situation going into the T+2 period. VIX up today, 4%. Gold up. Silver up. Oil up a little bit. And dollar down. Yeah, dollar's still down 30 BPS. Dollar down against the euro 33. So yields up. T-bill futures down. I mean, looking a little more bearish. Not regaining 4,200, I think is a good sign, but futures are currently still over 4,200. Futures are, right now trading at 4,205 and still right on that resistance line going into next week. So, a recovery is just as possible as a breakdown here. And we'll have to wait and see how that plays out. Makes me want to root for it. There were 12-15s? Really? Huh. Can we get some special shout outs to Gaff? Maybe he'll buy SPX calls next week to kick off the crash. Well, I'll be very interested to see what the report for the Treasury General account looks like over the next 2 days. Has anybody looked at today's? Oh, thank you, Gordon. Okay, $57 billion from 68 billion on yesterday's report. That's not moving the way it should be. Thank you, Lawrence, also. Appreciate it, guys. So yeah, sounds like Treasury General account's still down. Anything else? Nvidia closing today at 312. I mean, not the range I was hoping for, but still much better than it closing above 320. Can we get some special kind of shout outs to Gaff? 3100 1215s at 4201 block. Jesus Christ. That's a lot of contracts. Thank you, Darbwire, for checking that. Except Upstart downs next week. Yeah, Upstart's not looking too hot. You know, we got liquidity starting to collapse. It looks like we're gonna start turning around. Might have a period of stabilization before we really hit some shorting, but yeah, I mean, this is gonna contract, right? And you know, like contractions are bearish. You know, we got this boy right here. So probably down. I sold a bunch of $20 CCs. I bought a bunch of $23 puts for next week's expiration, and for June I bought $25 puts. So that should help hedge any additional downside beyond the covered calls. Gives me a little bit of extra leverage on it. GME. So I mean, GME still hasn't, you know, Fubo's liquidities, you know, realized and beginning to collapse. GME is not in that boat. GME is still remains illiquid, not sufficient covering. You know, over the last couple of days, you know, we had a little bit of liquidity realization, like if we really zoom in. We had a little bit of liquidity realization as ETF FTDs were covered, right? Through this period. But these aren't, you know, contracting yet in any meaningful way. So I would still want to see those move quite a lot more. You know, like you know, see this. This is a leading indicator. You're all welcome. And you can thank Dork. But yeah, I mean, you can see, you know, liquidity starts to resolve it's about 5 days. 5 to 8 days in advance. And we're seeing no liquidity resolution right now, which is I do not like. I'm gonna be completely honest. This is some, but it's not much, and it's the only reason I'm questioning it. And then XRT has just nosedived, right? Like it's just become super fucking illiquid. So they leaned on that more heavily to stabilize the upside here, which is gonna limit the potential, right? So, I mean, yes, it has a lot of potential moves, but no, it doesn't look like it's going to run. And we're not seeing any shorting, right? Like no borrow rate increase really turns me off the idea of trying to play this next week. But we'll see how it looks into the beginning of next week. And if it's looking a little more promising, then yeah, maybe. But, you know, even May OPEX, you know, we started to realize liquidity very, very early, right? You know, we were seeing liquidity start to flow in rapidly from like May 12th onward. And then we actually reverted back, which was frightening. But then, yeah, this is one of the reasons May was like a big surprise, right? We got shorted super hard after the OPEC's like settlement period was almost over, and then we didn't run till Wednesday morning. But like in August, we start to realize liquidity in advance of like where it actually gets covered. And that was kind of broken up, right? You had ETF FTDs here. We had a risk off on the basket here because of Bobby, right? And then they actually risked off even more liquidity here in September, at the beginning of September, with more ETF FTDs, like this period right here. It was like a 30% run. It wasn't nothing, but and you had some pretty good advance notice here in October. Liquidity was starting to be realized over a period of time, and until we hit that peak when the XRT FTDs were covered. So yeah, I think this is a pretty good indicator that nothing's currently happening. So yeah, anyway, that's about it. Thank you guys so much for hanging out. I'm gonna go try to enjoy the rest of my Friday. I will maybe see some of you on the gaming stream this weekend as I fuck around with the new Street Fighter game. Thanks everyone. I'll see you later.